So this chapter is valuation of mergers and acquisitions. Valuation of mergers and acquisitions. Let's start this chapter and let's see, what is the framework, what is the concept of mergers and acquisition. First of all, I would like to ask all of you, to calculate for me a simple equation which I am writing in front of you. Okay. So what is 1 plus 1? Please answer my questions in the chat box. मेरे सवालों का जवाब दो. And guys, do hit a like button. Okay. If you're watching, if you're live, then live will communicate your feelings to me. So do hit a like button. So your like will definitely motivate me. Okay. Please do hit a like button. So what is 1 plus 1? I want to ask all of you, what is 1 plus 1 in mathematical term? Yes, you all have studied mathematics. So what are you asking, sir? We are, CMA Final students. What are you saying? You are asking us 1 plus 1? No, I don't want philosophy. The philosophical students, please beware. I don't want philosophy. So 1 plus 1 is equal to 11. एक और एक 11. हमारी ताकतें सर कई गुना हो जाती हैं अगर दो लोग मिल जाते हैं. Philosophical answers I don't need. I want mathematical answers. Mathematical answers. What is 1 plus 1? Ajay More says 1. How can 1 plus 1 be 1? Okay. Amir says 2. Luffy Wish says 3. Jyoti says 1. Mohit says 2. Okay. So mathematically 1 plus 1 is equal to 2. But according to mergers and acquisition, 1 plus 1 is equal to 3. That is the golden principle of mergers and acquisition, which you need to first of all understand, that 1 plus 1 always should be 3. 1 plus 1 is equal to 3. That is the fundamental rule which is followed under mergers and acquisition. So why do you say that? So this is a mathematical error. This is an error in mathematics. No guys, this is not an error in mathematics. This is the principle which we follow in mergers and acquisition. I'll explain you how. So there are two companies. There are two companies, A Limited and B Limited. They both merge together to form a new company, AB Limited. The idea is to work together. So both these companies merge with each other, or one company acquire the others, or any other kind of combination. Some combination happens and A company and B company are working together to form AB Limited. Now please see the the analogy. Okay, so net profits which are earned by A Limited is 3 crores. Net profit which is earned by B Limited is 5 crore. Net profits which are earned by A Limited is 3 crores. Net profit which are earned by B Limited is 5 crores. So 3 plus 5 usually should be 8 crores. But in a merger and acquisition scenario, it has to necessarily be more than 8 crores. Unless and until two companies are merging together and they are reaping a little more extra profit than what was being earned by them before merger, this merger is not worthwhile. Why would I undertake the entire pain of going through the entire legal process of merger and acquisition and incurring the expenses of merger and acquisition unless and until I find some benefit? There has to be some benefit. There has to be something extra that one is earning because of this merger and acquisition effect to sustain this merger and acquisition. Otherwise, this merger and acquisition is a waste of time, it's a waste of money, it's a waste of effort. So when two companies come together, so when the two companies are combined with each other, either as a merger or an acquisition, whatever mode, when two companies are combined with each other, then the resultant company should have a little higher results as compared to the individual two companies alone. So the resultant figure should be higher than the individual figures. Yes, it can be 9 crores also, it can be 8.5 crores also, but it has to be more than 8 crores for sure. This is the principle which we follow under merger and acquisition, that guys, if two companies are joining hands, then there has to be some synergies. Synergy means the benefit of working together. And yes, over here the synergy is monetary. There can be non-monetary synergies as well. Yes, there can be reasons which are beyond monetary, reasons because of which the companies are merging together. That are also, acceptable. But there has to be some synergy benefit. There has to be something extra which the companies are earning because of the merging effort and acquisition effect. Only then merger and acquisition is actually fruitful. Otherwise, merger and acquisition is waste. It is waste of time, waste of money, waste of efforts if your merger and acquisition is not resulting into any synergy benefit. What do you mean by synergy? Synergy means when two forces work together, when two forces come together, they result into synergy. So if synergy is not there, then the merger and acquisition is a absolute waste. It's an absolute waste of effort, time and money. So the golden principle which we follow in merger and acquisition is that 1 plus 1 should at least be 3. It can be more than 3. It can be 4, 5, 6, 7, 8, 9, whatever. But it has to bare minimum be more than 2. It cannot be 2. It has to be bare minimum more than 2. This is the golden principle of merger and acquisition. While valuing merger and acquisition deals also, we will keep this thing in mind that there is something called synergy. There is something called extra benefit which accrue to the organizations as a result of this merger deal. There's something extra which results into these merger and acquisitions. So yes, this is the first principle, that there is something called a synergy effect. Now let us come on to our notes which I have shared with all of you on the WhatsApp group, okay? And those students who will be shifting to the app, these notes are saved in the app as well. If you see the app, then in the app you will get these notes in PDF. These are in printable format. Hard books will not be supplied to you as a part of this marathon lecture. These notes will be supplied to you only in soft copy, only in PDF format, which is printable format, so you can get them printed. In the app, you can download these notes, or in the WhatsApp group, I've already shared in the notes today morning. This is the number on which WhatsApp group is created. Please go on that WhatsApp group and you can download the notes from that WhatsApp group. Alright sir, got it. So valuation of merger and acquisition, the first thing is analyzing the premium offered to the target stockholders. Premium is nothing but the synergy benefit, okay? So synergy which accrues as a result of merger and acquisition, it is to be shared by both the companies. One is the bidder company, one is the target company. Bidder company means the company which is acquiring other company, and target company is the company which is getting acquired. So bidder company and target company are the two companies which are parties to this particular deal. So a purchase premium in the context of merger acquisition refers to the excess that acquirer pays over the market trading value of the company's shares being acquired. So whatever company is being acquired, as compared to the market value, there's something extra which might be paid to the shareholders of that particular company. That is known as a premium to the stockholders. Now, what do you mean by a swap ratio? A very, very important element. What is the meaning of a swap ratio and how is it relevant in a mergers and acquisition deal? Again, I'll take example of two companies. This is a bidder company and this is a target company. This is a bidder company, this is a target company. Now, assume that the market price per share of bidder company is rupees 100 and bidder company has number of shares as 10,000 shares are there of the bidder company. This is the target company which is getting acquired. So what will happen is all the assets and liabilities of the target company will be transferred to the bidder company. All the assets and liabilities of the target company, assets plus liabilities of the target company will be transferred to the bidder company. This will happen. Okay, and in return, the bidder is going to pay consideration to the target company. In return, the bidder is going to pay consideration to the shareholders of the target company. Whosoever are the owners of the target company, they will get some consideration. They will get some compensation from the bidder company. That is a usual, merger and acquisition deal which happens in usual scenario. Now, assume that bidder company has market price per share of rupees 100. And their number of shares are 10,000 shares are there of bidder company. And for target company, the market price per share is rupees 50. And the number of shares are 8,000. So there are 8,000 shares, shareholders who are there for the target company, and the market price per share of each share is rupees 50. Now what will happen is, all the assets and liabilities of the target company will be transferred to the bidder company, and a net asset value NAV will be calculated. That was the NAV. Okay, NAV will be calculated. Now, the bidder company will issue, some consideration to the target company. Assume that this consideration is wholly in terms of number of shares. So, the bidder company will issue new shares to the target company. That is a deal. There is no cash involved. Assume that there is no cash involved. One way of fulfilling the consideration is to pay cash. That is for sure there. Okay, you can pay cash. That's okay. But another way is that to pay to the target company, we are issuing shares and not cash. So assume that the entire consideration will be satisfied in terms of shares to the target company. So target company shareholders will acquire shares of the bidder company. Now you tell me in the chat box, the existing number of shares are 8,000. Existing number of shares are 8,000 and the market price of the share, which is equal to the NAV, net asset value is also the same, 50 rupees. Okay, assume that both of them are same. This represents the NAV of the target company. So assume that both are same. Now 8,000 number of shares are there and 50 market price per share is there for the target company. Now target company is asking bidder company, you give us your shares and you take assets and liabilities from us. So what will target company require? Target company will say, look, bidder company, you give us 8,000 shares of yours to us because we are 8,000 shareholders. Okay, we are 8,000 in numbers. So you give us 8,000 shares of yours to us and we will surrender all our assets and liabilities to you. In this case, the bidder company will be little reluctant. What will bidder company say? Bidder company say, no. What are you saying? Your shares value is only rupees 50. My shares value is double than your shares value. Your shares value is rupees 50. My shares value is double than your shares value. So I cannot give you 8,000 of my shares. The fair deal will be that I will give you 4,000 of my shares. I will give you 4,000 of my shares to get equivalent value in your company. So 8,000 is represented by 50 market price per share, right? Now when this 8,000 will be converted to 100 market price per share, the number of shares will be reduced to half. So bidder company will tell the target company, no, I am not going to issue 8,000 shares. 8,000 shares is too much. I am not going to issue 8,000 shares to you for sure. So what will you issue? So bidder company will issue 4,000 shares because 4,000 shares, multiplied by 100 will get the same value as 8,000 shares multiplied by 50. Because the worth was less, no? The worth was less. The worth of target company shares was less. So 8,000 shareholders will get 4,000 shares in the bidder company to have a fair deal. And this exchange ratio is known as the swap ratio. This exchange ratio is known as the swap ratio. So how many shares of a bidder company will be issued to the target company shareholders? That is known as the swap ratio or the exchange ratio. So what is the exchange ratio in this particular case? Exchange ratio is 0.5:1, which means the target company number of shares is 8,000. It is multiplied by 0.5. So we get to know how many shares are we going to get in the bidder company. Target company shareholders will get 4,000 shares in the bidder company. If you understood this concept, please write yes in the chat box. It's a very, very important concept, a very basic and a starting level concept of mergers and acquisition chapter. Okay, so 8,000 multiplied by 0.5. Now, where does this 0.5 come from? 0.5 is derived by dividing the market price per share of the target company by the market price per share of the bidder company. Market price per share of the target company divided by market price per share of the bidder company. What is the market price per share of target company? It is 50 rupees. What is the market price per share of the bidder company? It is 100 rupees. So 50 divided by 100 is equal to 0.5. So 0.5 is the swap ratio or the exchange ratio. Swap ratio or the exchange ratio. If you understood the concept, please hit a like button. Okay, I need to see a lot of likes and hearts being sent by you to me. Lot of hearts and lot of yes, very good. Swap ratio clear, sir, on the basis of MPS. Very good, perfect answer. Yes, so this is nothing but the swap ratio. Now, similarly, swap ratio can also be calculated using earnings per share. Whatever is the earning per share of the bidder company versus earning per share of the target company, using that also you can compute the swap ratio. So, now what is the formula of swap ratio? Formula of swap ratio is So first of all, let's read the definition of swap ratio. Swap ratio is the ratio at which an acquiring company will offer its own shares. Acquiring company means the bidder company will offer its own shares in exchange for the target company's shares during a merger or acquisition. For example, 10 shares of target company are exchanged for 1 share in the acquiring company. In this case, the swap ratio is 1:10. So it depends what shares are being offered by the bidder company to the acquiring company. That ratio is known as swap ratio or the exchange ratio, and this exchange ratio forms the basis of our calculation in the case of mergers and acquisition. Okay, so basis of computation of swap ratio. So swap ratio can be computed on the basis of EPS, MPS, book value per share, net asset value per share. So all these measures are used to calculate the swap ratio. So what is the formula of swap ratio? So formula of swap ratio is EPS or MPS or BVPS or NAV of the target company or the acquired company divided by EPS or MPS or BVPS, whichever you choose. Okay, you choose any one of them, whichever you choose, of the bidder company or the acquirer company or the buying company. So you have to always keep the target company's parameter on the numerator, target company's parameter on the numerator, and bidder company's parameter on the denominator. This is how you should always use this formula of swap ratio. This is a formula of swap ratio. Please comment a yes if you understood this entire formula of swap ratio. Please comment a yes. Yes, very good, superb. Superb. Now let us start the next topic, and the next topic is new earnings per share. What do you mean by new earning per share? What is the meaning of new earning per share? That's what we are going to see now. What is the meaning of new earnings per share? Okay, sir. So, you know the definition of earnings per share, right? So please, can you please calculate for me the earnings per share of A Limited? Please calculate for me the earnings per share of B Limited. Please calculate both of the things for me. I want you to calculate earnings per share of A Limited and B Limited for me. Please calculate and write in the chat box. Earnings after tax of A Limited 5 lakhs, number of shares 10,000. Earning after tax of B Limited 2 lakhs. Number of shares is 5,000. Please calculate the earnings per share for me before merger of A Limited and B Limited. Please calculate the earnings per share for me. In the chat box, please. Perfect. Perfect answer. It is 50 and 40. You just divide earnings after tax with the number of shares and you get the earnings per share of both of these companies. Perfect. Perfect. Very good answer. Very good answer by all of you. Perfect. Okay. Now, you have to tell me what is the new earnings per share of the new company. These two companies have merged together, and after merging it has created a new company which is AB Limited. You have to tell me what is the earnings per share of the new company. How can we calculate the earnings per share of the new company? So if I ask you, what is the earnings of the new company? What is the earnings after tax of the new company? Then you will tell me, sir, earnings after tax of A Limited plus earnings after tax of B Limited plus. Will there be something else to the earnings of the AB Limited? So you will tell me that if both the companies are merging together, A and B are merging together to form AB Limited, then the merged firm, which is AB Limited, what is the earnings of AB Limited? Then you will tell me, sir, you first of all add earnings of A Limited, then you add earnings of B Limited, obviously, because both these things are constituting to become a AB Limited. That's perfectly fine, right? Is there something else that I should add? Yes, absolutely right. Sir, there will be some synergy benefit also, because 1 plus 1 cannot be 2. It has to be 3. So there has to be some synergy benefit also. Very, very good answer by all of you. Very, very good answer by all of you. Divided by, what will I do? Number of shares of A Limited. Number of shares of A Limited. Okay. Plus number of shares of B Limited. Plus number of shares of B Limited. Number of shares of A Limited plus number of shares of B Limited. Now, one very important point to be noted over here is, sir, B Limited is being acquired. B Limited is being acquired. B Limited shareholders are being given some new shares of the new company, and shareholders are being, waived off. The number of shares are being waived off. The shareholders of B Limited are being sent off, and they are being acquired by A Limited. A Limited is issuing its own shares to the shareholders of B Limited. So B Limited will have new number of shares in its kitty, which means the old shares of B Limited multiplied by the swap ratio. The old number of shares which are there with B Limited multiplied by swap ratio, this will be the number of shares of B Limited, because B Limited in this case is the target company, A Limited is the bidder company. A Limited is the bidder company, B Limited is the target company. So A and B combined together will form new earnings per share. So numerator you are very well aware of, earning after tax of A Limited, earning after tax of B Limited divided by new shares of A Limited, which remains the same. A Limited is the target company, is the bidder company, remains the same. New number of shares of B Limited. B Limited will be issued new number of shares, like in our earlier example. B Limited was issued 4,000 shares. So the new number of shares will be affected by the swap ratio, which we have to compute. So the new number of share of B Limited will be old shares of B Limited multiplied by the swap ratio. So this is the formula of new earnings per share. This is the formula of new earnings per share. And guys, instead of just mugging up the formula, if you understand the formula, it will be much more beneficial for you in the examination, because you'll be able to remember well. So what is the definition of new earnings per share? New earnings per share refer to EPS available to the shareholders post merger. After merger, whatever is the earning per share which is available to the shareholder, that is known as the new earnings per share. Following formula may be used. Earnings of the bidder company, the company which is bidding, earning of the bidder company, plus earnings of the target company, plus the synergy benefits. This is the total earnings that is available to the merged entity, divided by shares of the bidder company plus shares of the target company multiplied by the swap ratio. Shares of the target company multiplied by the swap ratio. And yes, if the question doesn't specify any synergy benefit, then you can just keep it as 0. Synergy benefit can be 0. If the question doesn't specify any synergy benefit, then synergy benefit can be 0. That is also possible. So this is how new earning per share is calculated. This is a theoretical representation of new earnings per share. Before we come on to our other concepts, let us do one very simple question of calculating the exchange ratio first of all. Okay, let's calculate the exchange ratio, and let's see who all are able to calculate this exchange ratio to the perfection level. All right, sir? Yes. So Akash Limited wants to take over Vatsan Limited. So Akash Limited is the bidder company. You always write, okay, and Vatsan Limited is the target company. Vatsan Limited is the target company, and the financial data is given for both the companies. Financial data is as under: preference share capital is given to you, equity share capital is given to you. Equity share capital. So this is like 10 number of shares is 10 and number of shares is 5. Share premium is given over here. Profit and loss account and debentures is given to you, and total of the liability side of balance sheet is given to you. Then fixed assets is given to you, current assets and total of the asset side is also given to you. Profit after tax and preference dividend. So we have been given the profit after tax and preference dividend, and market price per share is also given to you. What should be the share exchange ratio? You have to compute the share exchange ratio to be offered to shares of Watson Limited based on these three criteria: NAV, EPS and market price per share. What should be the swap ratio according to these three parameters, and which should be preferred from point of view of Akash Limited, which is beneficial from point of view of Akash Limited. That is also a thing which you need to really compute. Okay, sir. So first of all, we are going to compute the exchange ratio on the basis of NAV, on the basis of EPS and on the basis of market price per share. So guys, market price per share is already given to us, so we can easily compute the EPS on the basis of market price. But unfortunately, earning per share is not given to us and net assets value is not given to us for either of the businesses. So we need to compute the earnings per share of both the businesses. We need to compute the net asset value of both the businesses. Okay, sir, got it. So first of all, let's compute the NAV of Akash Limited and Watson Limited. Let's compute the NAV of Akash Limited and Watson Limited, and NAV is a very simple formula, which we are all aware about. What is NAV? Total assets minus outside liabilities. NAV is total assets minus outside liabilities. That is the formula of NAV. So what is the total assets of Watson Limited? The total assets, obviously take it from liability side or take it from asset side. 173 and 61. 173 and 61. Okay, 61 for Watson Limited, 173 for Akash Limited. Okay. Then we have external debentures. Debentures are 10% debentures. Okay. So 5 lakh debentures are there and 15 lakh debentures are there. Then we have preference share capital. Preference share capital 0 and 20. Preference share capital is 0 and 20 for each of the companies, Watson Limited and Akash Limited. Now, what are the net assets? So these are the net assets which is attributable to the shares. So for Watson Limited, it is computed as and net assets which are attributable to Akash Limited is $138. So these are the net assets which are attributable to both the shareholders. NAV is 56 and 138. And how many number of shares are there? Number of shares are, Watson has 5. Akash has 10. So what is the NAV per share? NAV per share 11.2 and 13.8. 11.2 and 13.8 is the NAV. 11.2 and 13.8 is the NAV. Guys, you have to solve this question simultaneously along with me. Okay. Students who are seeing the recorded batch, for them also it's an instruction. Don't copy paste the solutions as it is. Solve with me, because in the examination I'm very sure that if you are not able to if you do not right now practice these questions in writing, then in the examination you might find hindrance in even calculating the basic of basic calculations. You might find some obstacle. So please don't take this chance. Don't audit the questions of BVM. You don't have to just read the questions of BVM. You have to practice it by your own hand. That's very, very important. Okay. 11.2 and 13.8. So now let us see what is the exchange ratio. 11.2 divided by 13.8, NAV of Watson Limited divided by NAV of Akash Limited. So the swap ratio is 0.81 times. What is the swap ratio? Swap ratio is 0.81 times. 0.81 times is the swap ratio. Okay, so now what is the meaning of this 0.81 times swap ratio? It means that Watson Limited, each share of Watson Limited will get 0.81 shares in Akash Limited. So 5 lakh shares are there of Watson Limited. In exchange of these 5 lakh shares, the Akash Limited will issue 5 lakh multiplied by 0.8 shares in its own company. 0.81 shares in its own company. Okay, that is the meaning. So 5 lakhs multiplied by 0.81 shares, it is 4,05,000 shares. So in exchange of 5 lakh shares, Akash Limited will issue 4,05,000 shares to Watson Limited. So what are the shares? Hence the swap ratio of ABC is computed as 0.81 times number of shares issued to shareholders of Watson Limited is 5 lakh number of shares, original number of shares 5 lakh multiplied by 0.81 times, which gives shares as 4,05,000 shares. Obviously guys, Watson Limited will want maximum number of shares to be issued to them. That will be beneficial for Watson Limited. But Akash Limited will think through, okay? Akash Limited will think what is beneficial for him as well, and then accordingly he will issue the shares. Okay. So how many shares are issued? 4,05,000 shares are issued by Watson Limited to Akash, by Akash Limited to Watson Limited in the first option. Now let us analyze the second option. Second option is to compute the earnings per share and accordingly find the swap ratio on the basis of earnings per share. Okay. Let's see what is the profit after tax and preference dividend given in case of both the companies. It's 24 lakhs and 15 lakhs. It is already given in the question, guys. 24 lakhs and 15 lakhs is the profit. How many number of shares are there? 10 lakh shares of Akash Limited. 5 lakh shares of Watson Limited. 10 lakh shares of Akash Limited. 5 lakh shares of Watson Limited. So earning per share is 2.5 and earning per share is 3. Earning per share is 2.5, earning per share is 3. So what is the swap ratio? On the basis of earning per share, what is the swap ratio? Swap ratio is computed as 2.5 divided by 3. Okay. Akash Limited earning per share is 3. No, it's vice versa. Oh, sorry, it's vice versa. So Watson is 3 and Akash is 3. Akash is 2.5. Okay. So Watson earning per share is 3, which is higher, and Akash's earning per share is lower. It's 3 and 2.5. Okay. So here Watson Limited has an edge. So the swap ratio is computed as 1.25 times. Swap ratio is computed as 1.25 times. That's the swap ratio. Okay, so swap ratio is 1.25 times. What is the Watson Limited shareholder should be issued? How many shares should be issued to Watson Limited? The existing number of shares is 5 lakhs. 5 lakhs multiplied by 1.25 times. Gives me a figure of 6 lakhs 25,000. So 6 lakh 25,000 are the shares which are to be issued and under the second alternative to the shareholders of Watson Limited. Now you tell me, if you are a shareholder of Watson Limited, what will you prefer? Will you prefer EPS as the basis of your calculation, or will you prefer NAV as the value of your calculation? If you are the shareholders of Watson Limited, tell me in the chat box. What will you prefer? You want higher number of shares or you want lower number of shares? You tell me that. Okay. Last is on the basis of MPS. MPS is not to be calculated. It is already given in the question. MPS is 24 and 27. 24 and 27. Already given in the question. $27 1.125. Absolutely right, absolutely. So if we are Vatsan Limited, then we will want more number of shares, more the merrier. If the number of shares are high, then it's beneficial for us. We want more number of shares, more the merrier. As many as countless shares we want. We want more number of shares for sure. So yes, if you want more number of shares, then definitely you will opt for EPS as the preferred choice of your calculation of swap ratio. But if you are the shareholders of Akash Limited, then you would want less number of shares to be issued to Vatsan Limited. If you are shareholders of Akash Limited, okay, then you would want NAV to be basis of your calculation. Then you won't want EPS or the MPS be a source of your calculation. So in that case, there will be a reverse situation. So in this case, the swap ratio is 1.125, and Vatsan Limited should issue how many shares? 5 lakh multiplied by 1.125 gives me a figure of 5,62,500. 5,62,500. 5 lakh multiplied by 1.125. Okay, so using 3 alternatives, we have suggested what should be the swap ratio. Now the question is asking, now it all depends on their negotiation, guys. Okay, now our role of a valuer is over. Our role is over in this particular deal. Now it will be between the owners or the promoters of the two companies to decide what ratio do they want, what is the percentage do they want. Now it is up to both of them. Our role is over. We have determined the swap ratio on the 3 bases. That is what was being asked from us. Now a very specific question again has been asked from us, that from the point of view of Akash Limited, what should be the preferred swap ratio. So Akash Limited is the bidder company. Okay, so the swap ratio which will be preferred by Akash Limited will be the swap ratio in which least number of shares are issued to the target company. Yes, the least number of shares which are issued to the target company, and accordingly NAV should be the preferred option for Akash Limited. He will want the deal to close near NAV. NAV should be the preferred option for Akash Limited. And if it was the case of Vatsan Limited, that we would have analyzed whether Vatsan Limited would what is the preferred choice with respect to Vatsan Limited, then our answer would be the maximum number of shares issued, on which basis EPS should be the answer in that case. EPS, earnings per share, should be the answer in that particular case, if the choice is made from the angle of Vatsan Limited. If it is made from the angle of Akash Limited, then NAV is the preferred option. So that is how we are judging the relevance of the swap ratios. Yes, NAV will be beneficial. Very good. Perfect. So you understood this concept well. Please write a yes in the chat box if you understood this concept very, very well. If you understood this concept well, please write yes in the chat box. So an important concept from an exam standpoint. Okay, let's move on to illustration number 2. Let's move on to illustration number 2. Illustration number 2 says, the following information is provided related to acquiring firm Mark Limited. So Mark Limited is the bidder company and Mask Limited is the target company. So again, there are two companies, Mark Limited and Mask Limited. Mark Limited is the bidder company. You write somewhere over here so that you remember this fact. Mark Limited is the bidder company and Mask Limited is the target company. The target company is Mask Limited and the bidder company is Mark Limited. These are two companies which are under consideration. So profit after tax of bidder company is given to you, profit after tax of Mask Limited, the target company is given to you. Number of shares outstanding is also given to you for both the companies. Accordingly, PE ratio is also given to you. PE ratio, the formula for PE ratio is MPS over EPS. You should remember these formulas because at any given point in time, the question can ask you to compute the MPS or EPS using the PE ratio. So PE ratio formula should be on your tips, which is MPS over EPS. Okay. Now the ask is, what is the swap ratio based on the current market price? You have to compute the swap ratio on the basis of market price of both the entities. Okay, we will compute it, no problem. What is the EPS of Mark Limited after acquisition? So we need to compute the new earning per share. We need to compute the new earning per share. But sir, tell us something. Sir, while computing the new earning per share, what is the swap ratio that we are going to take? Guys, always remember, if the question is silent on what is the swap ratio that you should take while computing the new earning per share, you will always take the swap ratio which is required to be computed by you in the above point. So in the above point, swap ratio is required to be computed on the basis of MPS. So in the next point, we are going to compute the new earnings per share on the basis of MPS only. That is the way you should understand this part. So what is the EPS of Mark Limited after acquisition? On the basis of current market price, we are going to compute this new earnings per share. What is the expected market price per share of Mark Limited after acquisition? Assuming P ratio remains the same. If P ratio remains the same, if P ratio is not changed, then what will be the the market price per share after acquisition? Next is determine the market value of the merged firm. What will be the market value of the merged firm? What market value will it command in the market if both the firms are merged together? And finally, calculate the gain or loss of shareholders of two independent companies after acquisition. You have to compute what is the profit or loss which has accrued to shareholders of both the companies pursuant to this merger and acquisition deal. Okay, sir, fairly a lengthy question, and this question typically will come for 8 marks in your examination. It's a very common question which comes in the examination with a little bit of tweaking. Okay, some part given here and there, some modulations might be there, but broadly this question comes in this particular format. Let's start illustration number 2. Okay, the first ask is you have to compute the swap ratio on the basis of current market price. Oh God, current market price is not given in the question itself. When current market price is not given in the question itself, how will you compute the swap ratio according to current market price? Oh, it's a big problem for me, guys. It's a big problem for me. The current market price is not given in the question. When current market price is not given in the question, how can I compute the swap ratio on the basis of current market price? It's a big problem. Current market price is not given in the question. But sir, we have been given information of profit after tax and number of shares. So what? So we can compute earnings per share using these two things. And if we compute the earning per share, then we simply have to multiply it by PE ratio to compute the market price per share. So yes, market price per share is not given in the question, but all the data which is required to compute the market price per share is given in the question. So will we be able to compute the market price per share? Yes, absolutely we'll be able to compute the market price per share in this case. Okay, sir, got it. So now my first working note will be compute the MPS of Mask Limited and Mark Limited. We will compute the Marks Limited and Mask Limited MPS by using the formula of EPS multiplied by the PE ratio. EPS multiplied by the PE ratio. Okay, sir. So profit after tax is given to us in the question itself. Yes, sir. Profit after tax is rupees 2000 lakhs, and for Mask Limited it is rupees 400 lakhs. For Mark Limited it is 2000 lakhs. Mask Limited is 400 lakhs. Number of shares is 200 lakhs and 100 lakhs. This is all pre-merger. Okay, pre-merger calculation is going on. 200 lakhs and 100 lakhs. Okay, sir. What is the PE ratio which is given in the question itself? The P ratio is given as 10 and 5. P ratio is given as 10 and 5. This is the PE ratio. Okay. Earning per share can be calculated by dividing profit after tax with number of shares. So this divide by this. This becomes 10. This becomes 4. 10 and 4 is the earnings per share. Then we can compute the market price per share by multiplying PE ratio with the EPS. Just multiply these two things, you will get the market price per share. Because the formula of PE ratio is MPS over EPS is equal to PE ratio. Okay. So if I reverse this formula, then I get another formula which is MPS is equal to PE ratio multiplied by the EPS. This is the reverse formula. MPS is equal to PE ratio multiplied by the multiplied by the MPS multiplied by EPS. This is the reverse formula. Okay. So we'll multiply these two. So the MPS is computed as 120. 120. Perfect. Very good. Now what is the exchange ratio. What is the swap ratio according to 120 formula? So guys, swap ratio is MPS of Maersk Limited divided by MPS of Maersk Limited. MPS of Maersk Limited is 20, of Maersk Limited is 100. So the swap ratio is 0.2 times. This is the swap ratio. Hence the swap ratio computed on the basis of MPS is 0.20 times. 0.20 times. This is the computation of the swap ratio. Perfect. If you understood this computation, please write a yes in the chat box that yes sir, we understood the computation. Please write a yes in the chat box. Okay. Now the next task is to compute the new earning per share post merger. What will be the new earning per share? New earning per share of Maersk Limited, that is the bidder company, post merger, after merger, because this bidder company will have target company also included in it after merger. So you have to compute the new earning per share. You have to compute the new earning per share. Now you have to compute the new earning per share. So what is the formula for new earning per share? Let's see. So the formula for new earning per share is the old earnings. The old earnings of Maersk Limited. First of all, we'll add the old earnings of Maersk Limited. So what is the old earnings of Maersk Limited? Is 2000 lakhs. So 2000 lakhs plus old earning of Maersk Limited 400 lakhs plus, if there is any synergy benefit, we are going to add that also. But sir, in this particular question, there is no synergy benefit which is being talked of. Yes, there is no synergy benefit which is introduced in this particular question. So we'll have synergy benefit as 0. We will always write synergy benefit in our question, but if it is not given in the question, we'll add a 0 to the synergy benefit. So synergy benefit will be 0. So what is the synergy benefit? It is 0. Okay sir, got it. So now what will be the number of shares of Maersk Limited? So number of share of Maersk Limited will remain the same. It is 200 lakhs. But number of share of Maersk Limited will undergo a change, because for 100 lakh shares of Maersk Limited, we are not going to issue entire 100 lakhs. Okay, we are going to issue something less, and less means it is multiplied by 0.2 times. It is multiplied by 0.2 times. 0.2 times is the swap ratio. So we'll multiply it by 0.2. So the new earning per share post merger is 10.91 per share. So what is the new earning per share post merger? It is 10.91 per share after merger takes place. Post merger acquisition. Okay. It is 10.91 per share. So what is the new earning per share of Maersk Limited after acquisition? Always guys, this concluding line is to be written by you after every answer. Do remember to write this concluding line after every answer. It's very, very important to conclude your answer well. That is a essential element in your examination of any practical subject. Not only SPMBM, any practical subject, conclusion is a must. You have to write conclusion after each and every step. So 10.91 is the new earning per share of Maersk Limited after merger. Okay sir, got it. What is the third part? So 2 parts done guys, 2 parts done. First part done, second part done. Perfect. What is the third part? Third part is, what is the expected market price per share of Maersk Limited? Oh, that we have already computed, no? Market price per share of Maersk Limited. But guys, that was computed pre-merger. The question is asking that now, what is the expected market price per share of Maersk Limited after acquisition? We have to now compute the the expected market price of Maersk Limited after acquisition. After merger, what will be the price? Okay. So after merger, what will be the price? After post acquisition, what will be the price? Assuming that P/E ratio of Maersk Limited remains unchanged. So the pre-merger P/E ratio of Maersk Limited will be same as post-merger P/E ratio of Maersk Limited. What will be the new market price per share? So guys, we are already aware that market price per share formula of any organization is P/E ratio multiplied by EPS. It's just that we have to find this entire calculation post merger. Okay. So we have to take post merger PE ratio. We have to take post merger EPS. What is the post merger PE ratio? Post merger PE ratio is 10 times. It is assumed that pre-merger, pre-merger PE ratio is equal to post merger PE ratio. So post merger PE ratio is 10 times multiplied by EPS post merger. EPS of Mark Limited post merger. Guys, over here we had already computed the EPS of Mark Limited post merger. It's already computed by us. It is 10.91. So 10 times multiplied by 10.91 per share. So the share price is 109.1 per share. 109.1 per share. This is the MPS of the Mark Limited post merger. If you understood this concept, hit a like button, guys. Hit a like button if you understood this concept. If you understood this concept, hit the like button. So the new EPS of Mark Limited will be 109.1 per share. Okay. Now, next part number 3 is also done by us. Conclusion is to be written after every part. Next part, determine the market value of merged firm. What is the market value of merged firm? What is the market value? That is computed of the merged firm. Entire merged firm market value is computed as what? So the merged firm market value is computed as number of shares post merger multiplied by market price per share post merger. So what is the number of shares post merger? Number of shares post merger is already calculated by us over here, guys, in this part. 200 plus 100 multiplied by 0.2. So 200 plus 20 lakhs. This is the number of shares post merger. Then what is the market price per share post merger? It is 109.1. 109.1 is the market price post merger. Okay, if you multiply both of them, so it is 220 multiplied by 109.1 gives me a figure of 24002 lakhs. Hence the NAV of the merged firm is computed as 24002. 24002 lakhs is the post merger market value of this particular firm. Now you tell me in the chat box whether if I add up the individual shares of both the companies, if I add up the individual shares of both the companies, individual market value of both the companies, will it be higher or lesser than 24 lakh to 24,002 lakhs? Whether it will be lesser or higher than this particular amount? Ideally, it should be lesser, because synergy benefit has to be kicked in, if not by way of profits, by way of anything else. So it should ideally be different, but let's see if it's different or not. The next part is asking us to compute the gain or loss to the shareholders of the both company. So what is the gain or loss which shareholders of both the company have experienced because of this merger? What is the gain or loss which the shareholders have experienced post this merger? That we need to find out now. So now value of shares post merger, value of shares pre merger, that is what we need to compute to the individual shareholders of Mark Limited. Okay. Now, shareholders of Mark Limited, what is the new market capital of shareholders of Mark Limited? So, the new number of shares of Mark Limited is 200 lakhs and each share has a value of 109.1 per share. So, 200 lakhs, 2000 lakhs, sorry. $2,000 shares or 200 shares? 200 shares, okay, 200 shares, yes. Okay, 200 multiplied by 109.1. This is the value of shares after merger, 21,820. And what is the value of the shares before merger? Old market capitalization before merger, the value of share was 200 multiplied by the old market price per share. What is the old market price per share? What is the old market price per share? The old market price per share is 100 for Mark Limited. Old market price per share is 100 for Mark Limited. So it is 20,000. So from a market value of 20,000, Mark Limited shareholders have increased to 21,820. 21,820. So 1820 is the escalation in value, the gain which has been earned by the shareholders of Mark Limited. 1820. Please write a yes in the chat box if you understood this concept. Please write a yes in the chat box. Yes, very good. All right, yes. So now the next part is we need to compute the gain to the shareholders of Mask Limited. So Mask Limited, what is the new number of shares? New number of shares is 20 lakhs. And what's the new market value? New market value is 109.1. So 20 multiplied by 109.1 gives me a figure of 2182. And what is the old number of shares? Old number of shares is 100 lakh shares, old number of shares. And what is the old market price? Old market price is 20. Old market price of Mask Limited is 20. So this gives me a figure of 2000 market capital. So what is the gain or loss? Again, there's a gain of 182 lakhs to the shareholders of Mask Limited. There is a gain of 182 lakhs to the shareholders of Mask Limited. So hence the gain to the shareholders of Mark Limited or Mask Limited is 1820 and 182 lakhs respectively. So this is the conclusion which definitely we have to show and put in every answer. In every answer a conclusion is a must. So the gain to shareholders of Mark Limited and Mask Limited is 1820. 1820 is the gain to the shareholders of Mark Limited and Mask Limited. Now in this particular question, guys, I'm going to tweak the question a little bit, okay, and you have to answer my question, okay. Now over here you have found out the gain in terms of market capital. Now what I want you to do is you find out the gain on the basis of market price per share and not the total market capital. I want you to find out the gain of both the companies on the basis of market price per share. Market price per share. Okay, what was old market price per share? What is new market price per share? On the basis of that, I need you to find out the gain to individual shareholder. Okay, so over here the market price per share, the new market price per share is 109.1 and old market price per share is 100. So if you talk about per market price per share, what is the gain? It is 9.1 in case of Mark Limited. It is 9.1 in case of Mark Limited. We have computed the gain in terms of total market capitalization. Now I want you to additionally compute the gain in respect of market price per share. I want you to do that. Question is not asking you to do that. I am asking you to do that. Okay. And I also want you to compute the change in market price per share of Mask Limited. Change in market price per share of Mask Limited. So Mask Limited new market price per share is 109.1. This is the new market price per share. The old market price per share is 20 per share. So the gain which accrues to Mask Limited is benefiting a lot, is 89.1 per share. So the gain which is accrued to Mask Limited is 89.1 share. So Mask Limited is actually gaining a lot of benefit out of this merger. Its per share value is increasing from 20 rupees to 109.1 rupees. Is this calculation correct or incorrect? Please tell me in the chat box. Is this calculation correct or incorrect? Please tell me in the chat box. because I have to introduce you a new concept because of this calculation. Please tell me in the chat box, is this calculation correct or incorrect? Guys, question doesn't ask you to do this, okay? I am asking you to do this. Question doesn't ask you to do this. Please comment in the comment section. Please tell me, is this computation correct or not? Calculation correct, but factually not correct. There are 5 shares, market value will be 109.1. I did not understand what you are saying. I did not understand what you are saying. My question is whether this calculation is correct or incorrect. Let's see if someone is able to find out what is the flaw in this calculation if it is incorrect. Okay, let me tell you guys, this calculation is incorrect. This is a wrong calculation. The benefit of market price per share which is accruing to Mask Limited is not 89.1. This calculation is incorrect. This calculation is wrong. Why is this calculation wrong? Let me introduce you to the next concept which we are going to deal with. The new concept is equalization. Concept of equalization. Equalization of MPS or EPS. Equalization of MPS or EPS is the new concept which I'm going to introduce to all of you. Okay. Assume that you have shares of a company, Reliance Industries Limited. You have shares of a company, Reliance Industries Limited, and you are holding 3 shares of Reliance Industries Limited, and the earning per share which you are earning from each share is rupees 2. Now you have number of shares is 3. You have 3 shares of Reliance Industries Limited and you are earning 2 rupees per share out of these shares every year per share. 2 rupees per share is the earning per share. Earning per share is rupees 2. Now Reliance Industries Limited is going to give you a deal, or it is going to give you a scheme of combination. Reliance Industries Limited is saying that we are consolidating our shares. We are combining our shares together. So shareholders, all of you, we are announcing that, we are combining our shares. So for every 3 shares, we will give you 1 share. We are combining our shares. It's known as combination. Shares are being merged to 1. Consolidation. So Reliance Industries Limited is saying we are combining our shares. So the 3 shares of Reliance Industries Limited, we are converting into 1 share. So all the shareholders who are having 3 shares, they'll be consolidated into 1 share. And we are happy to announce that the post-merger, post-consolidation, this is the post and this is the pre-figures, okay? We are happy to announce that after this, consolidation takes place, we will increase your earning per share to rupees 5 per share. This is a declaration which is being made by Reliance Industries Limited. We are consolidating our share. Number 1, for every 3 share, we'll give you 1 share. And we are increasing our earning per share. Wow, it's a big news. We are increasing our earning per share to rupees 5 per share from rupees 2 per share earlier. This is the announcement being made. You are the shareholders of this particular company. Tell me whether this announcement is good or bad for you. Sir, of course it is good. We are earning more. When we are earning more, then this announcement is good for us, sir. What are you even talking about, sir? From 2, we are earning more than double. Wow. 5 rupees per share is the earning per share, revised earning per share. We are earning double. So, of course, this is good for us. You have to tell me in the chat box whether this announcement is good for you or bad for you. Whether this announcement is good for you or whether this announcement is bad for you, you have to tell me in the chat box. You have to tell me in the chat box. Yes. मेरे सवालों का जवाब दो ना. Okay. One student is saying bad. None of you has any other opinion, huh? Any one of you is having any other opinion? Any one of you has any other opinion regarding this? Is it bad or is it good? It is good. Is it good or is it bad? Aisha Haris. Okay, very good. This announcement is bad for us. This announcement is not good for us because it is resulting into a loss. So how loss? It is profit. EPS is rising. No guys, you cannot just subtract 2 with 5 and say 3 is the earning per share increase that we are getting. No, this is an incorrect calculation. You have to see that in the old number of shares was more, it was 3. So 3 multiplied by 2, your total earnings was 6 in the erstwhile regime. And now your earning per share is only 5 in the new consolidated regime. So in effect, you are actually reducing your earning per share. Your earning per share is getting reduced and not increased. You cannot compare 2 with 5. Why? Because 2 has been computed on the basis of 3 number of shares and 5 has been computed on the basis of 1 number of shares. So these are not comparable. These are not comparable. 2 and 5 are not comparable with each other. But yes, 6 and 5 are comparable with each other. So whenever you are comparing earning per share, you also have to see the number of shares while comparing the earning per share. Otherwise, your answer will be incorrect. If the number of shares on which earning per share is computed is different, then your earning per share cannot be computed like this. So what should we do? What should we do to make both of these things comparable? The concept is equalization of old earning per share. So whatever is your old earning per share, our old earning per share is 2. You divide it by the swap ratio. You divide it by the swap ratio. What is the swap ratio in this case? 1:3, 1 by 3, okay. 33.33333 is the swap ratio. 0.33333 is the swap ratio. For every 3 shares, 1 share is being issued. So 1 divided by 3, which is 0.33333 is the swap ratio. So what I do is I divide 2 by 0.3333333 infinitely. So what is the old earning per share? Equalized old earning per share, 2 divided by 0.3333333. So the old earning per share comes out to rupees 6. And now you compare 6 with 5 and then you realize there is a decrease in EPS, which earlier you were thinking that there is an increase in DPS. No, there is no increase in DPS. There is decrease in DPS rather. So you are at a loss. You are suffering a loss. So number of shares has to be same while you are comparing the earning per share. This is the concept of equalized earning per share. Okay. Let us come back to our example. Okay. Let us come back to our question. Okay. Over here, you are comparing the market price per share, right? You are comparing the market price per share, but you are comparing it on the basis of wrong number of shares. I'll tell you how. I'll just tell you how. Just wait a second. I'll tell you what was the wrong thing that you were doing. Okay. Please see. Old market price per share is 20, but old number of shares is 100. New market price is 109, which is perfect, which I'm going to write again, 109.1, which is perfect, right? But the old earning per share, which is 20, is not comparable to 109 because old number of shares were 100 and old EPS was 20. So 20 is not comparable with 109. These are not comparable. We cannot reduce both of them. We cannot deduct both of them. This is not possible. So what are we going to do? We are going to equalize the old earning per share. What is the formula of equalizing old earning per share? Old earning per share, which is 20 in this case, divided by the swap ratio. So 20 is the old earning per share, right? So you have to see the equalized old EPS. Equalized old EPS is computed as old EPS divided by the swap ratio. Swap ratio is 0.2. So 20 divided by 0.2 is 100. 20 divided by 0.2 is 100. So the old EPS, equalized old EPS is 100 for Mask Limited also. So the benefit which shareholders of Mask Limited get is also 9.1, same as what was received by Mark Limited. And the earlier answer 89.1 is incorrect. 89.1 is incorrect. So the ask is, or the concept is, whenever you are required to compare the EPS and MPS, per share, any value which is per share. Whenever you are required to compare the per share value, if you are required to compare the total value, then no equalization required, no problem at all. If you are comparing total earnings, or if you are comparing total market price, no equalization required, no problem at all. Equalization is not required. If total earnings are required to be compared, or total market price is required to be compared, no equalization required. But if the question specifically asks you to compute the difference between earning per share, if the question wants to ask you the difference between earning per share or market price per share, what is the increase or decrease in the earning per share or market price per share, in that case, equalization is required for the old EPS or old MPS, as the case may be. Equalization is required in both these cases. After equalization, the gain or loss is computed as 9.1 and 9.1 in case of Mark Limited and Mask Limited respectively. This is the concept of equalization of old EPS or MPS. Please see this concept. Equalization of EPS or equivalent EPS. In case of merger of bidder company and the target company, number of shares of the target company undergoes a change. Now this is an important point, that target company number of shares is changed. Okay. In such a situation, if one wants to compare the pre-merger EPS with post-merger EPS of shareholders of the target company, it would not yield the correct results. The reason is simple. Old EPS is computed on the basis of pre-merger number of shares, and new EPS is based on the post-merger number of shares. Number of shares is different. Therefore, the difference will not be streamlined, right? Hence, before comparing the two EPS of target company, the old EPS should be equalized. This is the concept of old EPS equalization. What is the formula? Formula is equalized old EPS is equal to old EPS divided by the swap ratio. Equalization is required for target company only, not for bidder company, because bidder company number of shares doesn't change. Bidder company number of shares remain the same. Therefore, equalization is required for the target company only. Plus one very important thing, if the swap ratio is 1, suppose the swap ratio is 1, there's no change in the number of shares of the target company also, then no equalization is required. Then no problem, don't do any equalization. Okay, so this is an important concept which you should understand and know. And yes, growth, growth is a very important concept which requires your attention. How to compute the growth? The formula of growth is very simple. Retention ratio, whatever we are retaining out of our profits which are reinvested into business, retention ratio multiplied by return on equity. This is the formula for growth. We'll use this formula in many questions henceforth in going forward. So please remember this formula of growth. Retention ratio multiplied by the return on equity. Whatever we retain out of our profits multiplied by the return on equity, you will get the growth percentage. Whatever growth you will find, you will get the growth percentage if you multiply the retention ratio with the ROE. So this is the formula for growth. Okay, sir, got it. Let's start the next topic, and very, very important topic from an exam standpoint also, because a question mandatorily comes from this particular topic, which is value of firm. How is a firm value calculated? Valuation of a firm done. Valuation of a company done. What is the process of valuing a particular company? So this is a value of a firm. So guys, discounted cash flow is the most common method which is used to value any organization. Okay, if I want to value any organization, I will see what profits will it give me in the future. I will discount all those profits in the current period, and then I will value that particular organization. So valuation is nothing but discounting of the future cash flows, whatever future cash flows are there. I discounted at the current period at the current discounting rate, and then I compute the value of the firm. So the formula is very simple, discounting all the cash flows of a particular firm which it is expects to incur in the near future. We discount it at a present value, and that is known as the value of the firm. Now the problem arises when this discounting happens for an infinite time period. If the question gives us that yes, for infinite time period, for unlimited time, the revenue is going to be earned from this particular company, then the problem arises. And for that we have a capitalization formula, and the formula is this, that value of the firm is equal to free cash flow from the firm divided by the KE. A very simplistic formula without growth. So whatever the firm is going to earn in the next year, that divided by the cost of equity of the current year, overall cost of capital of the current year, that will be the formula for a firm which is earning a particular expected revenue for the infinite years, for the entire life. If they are earning the revenues, what will be the valuation? So free cash flow divided by the cost, this is the formula. Now if growth element is also there in the question, if it is given in the question, then the formula changes a little bit. What is the change formula? Change formula is free cash flow plus 1 plus growth rate. Free cash flow multiplied by 1 plus growth rate divided by cost of overall cost of capital minus growth. Overall cost of capital minus growth. This is a formula which you need to remember. Always remember that free cash flow of the next year will give you the revenue, the value of the firm of the current year. Free cash flow of the next year will give you value of the firm of the current year. So free cash flow of the next year divided by the overall cost of capital minus growth rate is the value of the firm of the current year. This is the formula of the value of the firm. Okay. Now what do you mean by free cash flow? It means earning before interest and tax into 1 minus tax rate. So usually we do not exclude interest from this calculation. Interest is included because we are calculating free cash flow of the entire firm. Okay. Then earnings before interest and tax rate. Then cost of capital or weighted average cost of capital is usually used in the KO formula. What is weighted average cost of capital? Weighted average cost of capital is nothing but cost of equity multiplied by weight of equity plus cost of debt multiplied by weight of debt. That is the weighted average cost of capital which is computed. Okay, so then growth rate is always a part of this calculation, because growth is added in the numerator, growth is reduced in the denominator. That's why growth forms a essential element of this particular calculation. Okay, let's directly jump on to a very good question which came in June 2025 attempt, and it's a very good question, guys, which has been drafted. So two firms, Rajan and Rekha Corporation, operate independently and have the following financial statements. Financial statements are given for two firms who are operating independently. Rajan is operating independently. Rekha is operating independently. 8 lakh worth of revenue, cost of goods sold 6 lakh. So 2 lakh is the EBIT, and 4 lakh is the revenue, 2,40,000 is cost of goods sold, and 1,60,000 is the EBIT. Expected growth rate is 6% and 8% for both the organizations. Cost of capital is 10% and 12% for both the organizations. Both the firms are in steady state with capital spending offset by depreciation. So there is no depreciation expense. The entire capital is depreciated in one go. No working capital is required, and both the firms face tax rate of 40%. 40% is the tax rate which is given for both the firms. Combining the two firms will create economies of scale in the form of shared distribution and advising cost. If we combine these two firms, then there will be synergy benefits. Synergy benefits is given to you in form of reduced cost of goods sold from 70% of revenue to 65% of revenue. So cost of goods sold, which currently is 6 lakh divided by 8 lakhs, this is 75%, and 2,40,000 divided by 4 lakhs, this is 75%. And this is 60%. Okay, 2,40,000 divided by 4 lakhs, 60%. Okay, so 75% and 60% for the combined organization. If they combine together, then the new cost of goods sold will be 65% of the revenues. It will undergo a change. It will be 65% of the total revenue. The combined cost of goods sold will be this. Assume that firm has no debt capital. There is no debt capital. You have to compute the value of the two firms before merger. What is the value of the two firms? First of all, you have to compute before merger, and then value of the firm, combined firm with synergy effect after merger. Value of individual firms before merger, and what is the value of the combined firms with synergy effect after merger. These are the two things that you need to compute. So guys, to compute the value of the firm before merger, it's very easy. We just use the individual data to compute the individual value. Simple. Okay, let's first of all do the first part, because first part is very easy. So the calculation of free cash flow will be EBIT into 1 minus tax rate. Okay. 2 lakh and 1,60,000. Two lakh and 1,60,000. This is 1,20,000. This is 96,000. So what is the free cash flow? Free cash flow is this. Free cash flow is this. One lakh 20,000 and 96,000. Now we just put this free cash flow into the formula. So Rajan, one lakh 20,000 and Rekha 96,000. We'll use the individual growth rate of both of these entities. 6% is the growth rate for Rajan and 8% is the growth rate for Rekha. 6% and 8% respectively. Okay, so 1,20,000 plus 6% divide by the cost of capital minus the growth rate. Okay, cost of capital is already given in the question. 10 and 12 is the cost of capital. So 10 minus 6% is 4%. So divide by 4%. The value is computed as 31,80,000. And guys, please compute this value. Most students are doing error in computing this value because this divide by 4% is little tricky. Divide by 4% is little tricky. So please compute this 31,80,000 yourself on a calculator. Now I calculate the value of Rekha Limited. 96,000 plus 8% divided by 4%. So what is the value of the combined firm? Value of the two firms independently. Value of the two firms independently is 577,200. 577,200 is the value of the combined firms, value of the firm individually without combination. Without combination, these two firms individually will be valued at 577,200. Okay, now the ask is that we need to now compute the value of both the firms combined together. If both the firms combined together, then what will be its value? The combined revenue is to be taken, the combined synergy benefit is to be taken, everything is to be taken combined. Okay, now what is the combined revenue of both the firms? The combined revenue of both the firms will be 8 lakhs and 4 lakhs. So the combined revenue is 12 lakhs for both the firms. Now what will be the cost of goods sold? Cost of goods sold will be 65% of 12 lakhs. Okay, because the question specifies that after combining, the cost of goods sold will be 65%. So 12 lakh multiplied by 65%. So the cost of goods sold will be 78,000. The cost of goods sold will be 78,000. So 12 lakh minus 78,000. So the EBIT will be 11,22,000. EBIT will be 11,22,000. Okay. Now we need to compute the cost of capital. Now guys, individual cost of capital is given to us 10% and 12% is the individual cost of capital of both the companies. And individual growth rate is also given to us 6% and 8% is the individual growth rate of both the companies. We have to compute the combined growth and combined cost of capital. Sir, simple. You add both of them. 14% and 22% you add both of them to calculate the combined growth and combined cost of capital? No guys, this is wrong. We don't combine, we don't add in this particular case, we don't add both the growths to compute the new growth or both the cost of capital to compute the new cost of capital. We don't combine that. We prorate them on the basis of their values. I'll tell you how. So 6% and 8% is the growth rate, right? Okay, first let's calculate the weighted average cost of capital. So 10% is the cost of capital of Rajan and 12% is the weighted average cost of capital of Rekha. So you know, prorate it, okay? So 10% is of Rajan. So 10% multiplied by 31,80,000 divided by 57,72,000 and 12% multiplied by 25,92,000 divided by 57,72,000. You'll prorate the cost of capital using the value of the firm, value of the individual firm. You'll prorate it. So you'll prorate it using the value of the individual firms. That is a very important step to do. 10% is the individual cost of capital of Rajan and 12% is the individual cost of capital of Rekha. Now you prorate both of them, okay? 10 divided by 5772000 multiplied by 5.51. 12 divided by 5772000 multiplied by 2592000. 5.39. What is the combined cost of capital? Anyone, if you computed it, please tell me in the chat box. Because I want you to compute it. That's the whole point. I want you to compute it. I don't want to just compute it, put it on the board and then you copy it. I want you to compute it. .9%. 10.9% is the combined cost of capital. The combined cost of capital is 10.9%. What is the weighted average expected growth rate? What is the growth rate? Again, same prorata technique is to be used, guys. 6% is of Rajan. Rajan's value is 31,80,000 out of 57,72,000. And Rekha's value is 25,92,000 out of 57,72,000. 57,72,000 out of that 25,92,000 is the value. Okay, so 6 divided by 5772000 multiplied by 31800. This comes out to 3.31. 8 divided by 5772000 multiplied by 2592000. 3.59. This comes out to the second answer, please. Second answer, please. Please write in the chat box. .9%. 6.9%. 6.9%. Okay, please let me know in the chat box if you understood this concept well. Okay, so now we are good to go. Okay, our growth is approximately 7% and the cost of capital is approximately 11%. Our growth is 7% and cost of capital is approximately 11%. Now, what is the value of the firm with no synergy? If there's no synergy at all, what will be the value of individual firms? Okay, now the question has specifically hinted you. Please see this. So, combining the two firms will reduce the cost of goods sold from 70% of revenue to 65%. So, without synergy, the revenue as a percentage, cost of capital as a percentage of revenue will be 70%, and after synergy it will be 65%. So, before the synergy kicks in, it will be 70%. So, total revenue is 12 lakhs in both the cases. Total revenue is yes, 12 lakhs in both the cases, 12 lakhs and 12 lakhs. Total revenue is 12 lakhs in both the cases. And now we are reducing the cost of goods sold from this particular 12 lakhs. So 70% in the first case and 65% in the next case. 12 lakh multiplied by 70%, this comes out to 8 lakhs of 40,000, and 12 lakhs multiplied by 65% comes out to 7 lakh 80,000. Four lakh 20,000. What will be the growth rate? Growth rate will be the combined growth rate we have already computed, guys, 7% and 7%. Okay. And what will be the cost of capital? Cost of capital will be 11% in both the cases. Cost of capital will be 11% in both the cases. So what will be the free cash flow after the taxes, EBIT after the taxes? So 3,60,000 minus tax rate is 40%. Comes out to 2,16,000 in the first case, and 4,20,000 minus 40% comes out to 2,52,000 in the second case. 2,52,000 in the second case. Now we will compute both the values, one with synergy and one without synergy. One is with synergy and one without synergy. Okay, so value of the firm without synergy, 2,16,000 multiply by growth, 11% minus 7%. 11% minus 7%. So 2,16,000 multiplied by 1.07 divide by 11 minus 7 is 4%. So value without synergy is 577,800, and value with synergy is 252,000. 2,52,000 plus 7% divided by 4%. 674100. This is the value. So what is the value of firm with synergy? Value of firm with synergy is computed as under. Please let me know if you understood this concept well. Yes, please write in the chat box if you understood the concept well. So this is the value of the firm with synergy, value of the firm without synergy. This is the answer. 57,78,000 and 67,41,000. And the individual values, okay, without any calculation, the individual values was 57,72,000. 57,72,000, which was almost equal to this value, 57,72,000, almost equal to the value with no synergy. So yes, a value with no synergy can also be computed by combining the individual firm's value without synergy. That can also be one of the methods. So this is the value of the firm with synergy and without synergy. Okay, sir, got it. Okay, let us now see one more question which is really interesting. Came in June 2025 attempt, guys. Tweaking our computation a little bit and using the concept of discounted cash flow, that is the regular discounted cash flow, in great detail. Okay, let's see this question. Illustration number 4. Pritham Limited is considering acquisition of Soham Limited. So Pritham Limited is the bidder company. Soham is the target company. Okay, which has 3.1 crore shares issued. So Soham Limited number of shares is 3.1 crore shares. Okay, the market price per share of Soham is 440. Market price per share is 440. Pritham Limited average cost of capital is 12%. Pritham Limited cost of capital is given to you. Soham market price is given to you. Cash inflow of Soham is given to you for next 3 years. This is the cash inflow of next 3 years. 460 crores, 600 crores, 740 crores. You are required to calculate a range of valuation that Pritham has to consider. So what can be the range of valuation that Pritham can consider, based on the data which is given to you? Market price is given to you. Okay, market price of Soham is given to you. That can be one of the, ways of calculating the value of Soham Limited. And the second way of calculating the value of Soham Limited can be the discounted cash flow. And that is how you'll develop a range. Range means 2-3 valuations need to be computed. Okay, sir, got it. All right, let's start. So first of all, what is the market price per share of Soham Limited? It is 440, and purely based on this market price, which is 440, what is the current price of Soham Limited? It is 440 multiplied by 3.1 crores number of share. 440 divided by 3.1 crores. So the total value of Soham Limited, the first range, okay, this is based on MPS. So the value of Soham Limited based on MPS is computed on the basis of the data which is given in the question itself. Question itself is giving the data, so we need not call out the data. The question itself is giving us the data. So the value of Soham Limited is 1364 crores. This is the first range. Okay, now we will calculate another value of Soham Limited based on the discounting cash flow. The cost of capital percentage is given to us 12%, and based on the cash flows we will calculate the present value. Okay, now it is rupees 460 crore. Present value factor is to be written over here first. So 1 divided by 1.12. I hope you understand the calculation of present value factor. Okay, it is 1 divided by 1.12. This is for the first year. 0.893. This is for the first year. I do an equal to, this will give me the PF for the second year. So PF for the second year is 0.797. This is for the second year. I do another equal to, this will give me the PVF for the third year. So PVF for the third year is 0.712. This is the PVF of the third year. I hope you understand this computation well, because this computation is going to be really important. Okay, so this is the PVF of the 3 years. Now 460 multiplied by 0.893. This is 410.78. 410.78. I put it in M plus because I have to get the total as well. So 600 multiplied by 0.797. This is 478.2. M plus again. Then 740 multiplied by 0.712. Again M plus. 526.88. Then I'll do a MRC. The total value is 1415.86. So please understand how to use M plus and MRC in the examination. That's going to be really important for you. Okay, so 460 into 0.893 M plus 410.7. Okay, and 600 multiplied by 0.797 M plus 478.2. Then 740 multiplied by 0.712, again M plus 526.88. MRC 1415.86. This is the value based on discounted cash flow. This is the value of Soham Limited based on discounted cash flow. Because we were required to compute a range, we were not required to compute how acquisition deal works, how merger deals work, and how two companies come together to form another company. So I'll take a similar example. There's a company which is undertaking a company. So this one is the target company, this one is the bidder company. Okay, and this is the target company. So bidder company is acquiring target company. So target company will form part of bidder company. So all the assets and liabilities of the target company will form as part of bidder's assets and liabilities. And in return, the bidder company will give its shares to the target company. Okay, this is how the deal will happen. So all the assets and liabilities will be transferred from the target company to the bidder company. And in return, the bidder company will issue its shares in the bidder company. It will issue its shares to the target company shareholders. That is the reciprocal arrangement which will happen in this particular case, and this reciprocal arrangement is going to be the basis of our deal of mergers and acquisition that we are going to value. Now the moot point of consideration over here is, which I had told you in the last class also, guys, there's something called a synergy benefit. There's something called a synergy benefit, which is very, very important from a merger and acquisition standpoint. If merger and acquisition does not have any synergy benefit, if the synergy benefit is zero, then it is not a good idea to do this merger and acquisition. It is not a good idea to actually merge these two companies if there is no synergy benefit. So synergy benefit has to be an important element of our deal to really facilitate the merger and acquisition deal. So I'll give you an example. Okay, now suppose the value of bidder company is 100 crore rupees. Value of target company is 80 crore rupees. Value of target company is 80 crore rupees. Together, if they join hands, then they form a company which is worth 200 crore rupees. So value of target company is 80 crore rupees. Value of bidder company is 100 crore rupees. If they both join hands, then the combined value is 200 crore rupees. You please tell me, what is the synergy benefit? So the synergy benefit is 20 crore rupees. 20 crore rupees is extra, which is fetched if both these companies work together. Now, while the consideration will be decided, what will bidder company give to the target company shareholders, because target company shareholders have to go. They have to surrender their assets and liabilities, and they have to go. Now the question is, what will bidder company pay to target company shareholders? What amount will bidder company pay to the target company shareholders? Your obvious answer will be, sir, 80 crores will be the amount that will be paid by bidder company to target company. 80 crores will be the amount. The value which target company has, that amount will be paid by the bidder company to the target company. So ideally, the purchase consideration, the shares which are to be issued by bidder company to target company should be 80 crore rupees. So bidder company was offering 80 crore rupees to target company. That target company, take your 80 crore rupees and please go. Now this company, both the companies will be handled by the management of only bidder company. Bidder company will be whole and sole responsible for management of both the companies. So you take 80 crore rupees and go away. Target company is not going away. Target company is saying, very chalak bro, very chalak. You are very smart, huh? Bidder company, you are very smart. You are giving me 80 crore rupees, that is fine, that I deserve, because that is value of my company, that I deserve. But listen, bidder company, don't be very smart, huh? I also deserve some fair portion of 20 crore rupees also. You will earn, because of me, you will earn 20 crore rupees extra. Your value will increase by 20 crore rupees extra. You will be benefited by 20 crore rupees extra. And you are not giving any part to me. So some part of this 20 crore should also be given to me along with 80 crore rupees. And this is the fair point. Now this is a negotiation point, guys. There's no formula that can tell you that, okay, out of this synergy, you give this much to the target company. There's no formula for it. It is a negotiation. It is how two people negotiate together. Just like you go to market and you say, भैया ठीक ठाक लगा लो, ना आपकी ना मेरी, 100 रुपए आप बोल रहे हो, मैं 60 रुपए बोल रहे हैं, भाई आप 80 रुपए का लगा लो, ठीक ठाक लगा लो भैया. So please be fair. You know, whenever you go to a shop, you bargain with a shopkeeper, right? Similarly, there's a bargain, there's a negotiation which will happen over here. And the negotiation will result into this synergy benefit being divided into target company and bidder company. Obviously, guys, when 20 crores is being accrued by combined efforts of target and bidder company, then it should accrue, to both the companies. Both the company deserve a share of 20 crores. Yes, I understand that in future the company will be run by bidder company. Whole and sole management will be in hands of the bidder company. Both the company consolidated will be handled by the bidder company. I understand that, but still, the target company deserves some fair bit of synergy benefit also. Okay, so after negotiation, it is decided that the target company will get 80 crore rupees plus 5 crore rupees extra. So target company will total get 85 crore rupees. So target company will total get 85 crore rupees. It is decided that out of 20 crore, 5 crore rupees will be given to the target company shareholders. So now, what is the technical word known for this 5 crores extra which has been given to target company? What is the technical term which is used for this 5 crore? The technical term which is used is in this particular case is purchase price premium. Purchase price premium. This is the technical term which is used for this extra 5 crores which is given to target company shareholders as a part of synergy benefit so that they are benefited. This is known as the purchase price premium. This is known as the purchase price premium. So please remember the technical words. It's very, very important. What is 20 crores? Synergy gain. What is 20 crores? Synergy gain. This is known as synergy. And what is this 5 crore rupees extra which has been given to the target company? This is known as the purchase price premium. Both the things are different. Students often confuse these two things. Sir, purchase price premium is the same as synergy gain. No, not at all. Purchase price premium is the extra amount which is given to the shareholders of the target company. And what is this 20 crore rupees? This is the synergy gain which will accrue to both the companies after merger takes place, after acquisition takes place. What is the additional benefit which accrues because of this merger? That is known as synergy gain. So this is synergy gain, and this is the amount out of synergy gain which is paid to the shareholders of target company. So 5 crore rupees is the purchase price premium. Now I would like to ask you, what is the bidder company gain? If I ask you, what is the bidder company gain? Bidder company is earning what? What is the gain that bidder company has accrued? What is the gain that bidder company has? What formula can you suggest me? What is the formula of acquirer's gain or the bidder company's gain? What gain has acquirer earned? If I want a formula for this, what will be the formula? What is the benefit of acquirer company? What is the benefit of bidder company because of this merger? If you have to compute this, then what will be your formula? Please tell me in the chat box. Let's see if someone, just out of your general knowledge or just out of your logic, pure logic, you please tell me what is the acquirer's gain or the bidder's gain that is accrued in this particular merger and acquisition deal. Okay, so first thing I can definitely suggest is, sir, the benefit that is accruing to the bidder company is synergy. Yes, synergy gain is the first thing that is earned by the bidder company. But out of this synergy, some portion has been given to the target company shareholders. And what is that some portion? That some portion is purchase price premium. What is the sum portion? What is the portion that has been paid to the target company shareholders? It is the purchase price premium. So what is the formula for computing the acquirer's gain, for computing the bidder's gain? What is the formula? Formula is synergy gain minus the purchase price premium. When you subtract purchase price premium from synergy gain, you get the benefit which is accrued by bidder company. So what is the benefit which is accrued by bidder company? The benefit which is accrued by the bidder company is this 20 crore rupees, which is the synergy gain minus the purchase price premium which has been shared with the target company shareholders. So this is a loss to the bidder company, 5 crore rupees. This is a gain to the bidder company, 20 crore rupees. So what is the net gain which has been earned by the bidder company? The net gain which has been earned by the bidder company in our case is 15 crore rupees. This is the acquirer's gain or bidder's gain. Now please tell me in the chat box, are you very well aware about these two words? Synergy gain and purchase price premium. 15 crore. Very good answer. Perfect answer. Did you understand this concept of Bidders gain or acquirers premium. And do you understand two words? What are those two words? Synergy gain and purchase price premium. Did you understand these two words? Because they are very, very important words and they have to be kept separately, guys. Okay, don't mix up both of them, don't jumble up both of them. Both these words are different words: synergy gain and purchase price premium. Okay, so now let us come to our book and let us understand what is the definition of purchase price premium. A purchase price premium is the difference between the estimated real value of the share of a company and the actual price paid to obtain it. So what is the real value of that company or the target company actually? What is the real value of the target company and what price has actually been paid to obtain it, because that price can be little higher than the real value of that particular company, so that price can be little higher. Purchase price premium or acquisition premium represents the increased cost of buying a target company during a merger and acquisition. The acquisition premium can also be evaluated using share price. Following formula may be used. So purchase price premium or acquisition premium is equal to offer price of target company share. So what is the offer price of the target company's shares? What are we offering as a price for target company shares? Divide by actual worth of the target company. So the acquisition premium in terms of times, okay, how many times are we paying extra to the target company can be computed in terms of times. It can be computed by dividing the offer price of target company by the actual worth of the target company. So in our question, in our example, if I were to calculate the purchase price premium in times, in number of times, then it will be 85 divided by 80. I am paying 85 crore rupees for a company whose worth is 80 crore rupees. That is the purchase price premium in terms of times, okay? And in terms of rupee, it is 15 crores. Okay, so got it. So for instance, if ABC Limited is currently trading for 264 per share, there's a company which is trading for 264 per share, and the acquirer is willing to pay 346 per share for the target company's outstanding shares. The acquisition premium can be calculated as 346 divided by 264, which is 1.3106 times. This is how the acquisition premium is calculated, and this is how we understand that what portion of the synergy benefit is being shared with the target company. So this is the proportion of synergy benefit that is being shared with the target company, and that is how the times, the number of times is calculated. This is the times the purchase price premium is calculated. So in the examination also, whenever the question asks you for purchase price premium, you should always calculate in terms of times only, not in terms of rupees. No, times. So this is how the purchase price premium is required to be calculated. Alright, let's do one question, and yes, it's an examination question. Illustration number 5. Acquiring company is considering acquisition of target company in a stock for stock transaction. Okay, it's a pure stock transaction, which means shares will be traded off. Okay, target company would receive 90 for each share of its common stock. The acquiring company does not expect any change in price and earnings ratio after the merger. Chooses to value the target company conservatively by assuming no earnings growth during the synergy. So there is no growth and there is no change in the PE ratio. PE ratio also remains the same. What we are paying to the target company is rupees 90 for each share. Now if I want to compute the purchase price premium, that I want to know what is the actual worth of this share. Okay, we are paying 90 rupees for this share to the shareholders of the target company, but what is the actual worth of this share, that we want to know. Okay, sir. So it says calculate the purchase price premium, exchange ratio, number of new shares, post-merger EPS of the combined firm, pre-merger EPS of the acquiring company, pre-merger PE ratio, post-merger share price, and post-merger equity ownership distribution. Okay. Additional information which has been given to you is that acquiring company and target company earnings are 2,50,000, 72,500, number of shares are 110,000. 20,000. Market price per share is rupees 50 and rupees 60. Now we got this critical information, guys. What is the value of target company shares? Rupees 30 is the value of target company shares before the merger. The target company shares value is rupees 60. And what are we paying for this share? Rupees 90. Why are we paying extra? We are paying extra because there has to be a synergy gain which is even more than this amount and which is accruing to us. And that is the reason why we are ready to pay extra to the shareholders of the target company. We are paying extra, guys. For a 60 rupee share, value of the share is 60 rupee. We are paying 90 rupees for that particular share. For a share which is worth 60 rupees, we are paying 90 rupees, 1.5 times higher. Why? The reason is very simple. The synergy gain would have been really good in this particular acquisition process and merger process. That's why we don't hesitate in sharing our benefit, the synergy which we got, sharing our benefit with the the target company. We don't hesitate in that. That is the reason why we are ready to pay extra also. So that is how the calculation is given. Okay, sir, got it. So now the first ask is that what is the purchase price premium? What is the premium that we are paying for this particular share? And I want you to compute this purchase price premium and give me the answer in the chat box. You please tell me what is the purchase price premium. I am not telling you. You tell me what is the purchase price premium and give the answer in the chat box. It's very, very simple, guys. Very, very simple. And I think in the answer, in the question itself, while describing the question also, I've told you the answer. Answer is in the question itself. Question is, this is the question. I have also shared the PDF in the WhatsApp group, guys. WhatsApp group has the PDF. This is the question. Please check out the PDF, and those students who are watching the recorded version of this lecture, your PDF will be saved in the app itself. In the app, there is a PDF which is saved. Yes, perfect answer. Perfect answer. Very good answer. It is 1.5 times. The answer is yes, correct. So the purchase price premium, very good answer. The purchase price premium will be 90 divided by 60. So it is 1.5 times, and 1.5 times is the purchase price premium. This signifies that shares of the target company are being valued 1.5 times more than its fair value. Very good answer. Perfect answer. 90 divided by 60, 1.5 times. Now I want you to answer the second question as well. Second question is, what is the exchange ratio? What will be the exchange ratio of these shares? 20,000 shares are the existing 20,000 shares are there. Okay. Now what are the new number of shares? Divide by the old number of shares. That will be the exchange ratio. So you have to compute the exchange ratio. So number of shares issued to target company, that is the bidder company's shares which are issued to target company. Bidders shares which are issued to target company. Number of shares existing with target company before merger. Okay, that this is 20,000. The denominator is 20,000. You have to compute the numerator. What will be the numerator? And then you have to tell the exchange ratio. Please tell the exchange ratio also. All right, yes, please tell me what is the share exchange ratio? Is anyone able to compute the share exchange ratio? Please comment if yes. What is the share exchange ratio? What should be the share exchange ratio that you need to compute? Okay, so what will be the share exchange ratio in this case? Now, for every 60 rupee share, we are going to pay worth 90 share. Okay, worth 90 share we are going to pay for every 60 rupee share. Okay, so we are going to give the value of 90 rupees to our target company. That is the that is the thing. Okay, so now what are the benefits to be given to shareholders of target company? We are going to give 90 rupee benefit to the shareholder of target company. Okay, we are going to give 90 rupee benefit to the shareholder of the target company. And how many shares are there of the target company? 20,000 shares are there of the target company. We are going to give 90 rupees per share benefit to the target company. How many shares are there of the target company? 20,000 shares are there of the target company. And what is the price per share? Current price per share. The current price per share is 60 rupees. Current price per share is 60 rupees. Okay, so 90 rupees multiplied by 20,000 divided by 60 rupees. Okay, we have to take MPS of the acquiring company. Sorry, not 60 rupees, MPS of the acquiring company. MPS of the acquiring company is rupees 50. Rupees 50 is the MPS of the acquiring company. Okay, so we have to give the benefit of 90 rupees to the shareholders of the target company. We have to give benefit of 90 rupees. So 20,000 multiplied by 90 worth of amount we have to give to the shareholders of the target company. Okay, and we have to issue shares worth 18 lakh rupees to the shareholders of target company. Shares worth 18 lakh is to be issued. 90 multiplied by 20,000. And what's the share price of one share of the company, acquiring company? It is 50 rupees per share. So 18 lakhs divided by 50 rupees. 36,000 shares are to be issued to the shareholders of the target company. 36,000 shares are to be issued. So number of shares to be issued to the target company is 36,000. So 36,000 shares to be issued to the target company's shareholders. 20,000 is its existing shareholding. So 36,000 divided by 20,000 gives me a figure of 1.8 times. So the swap ratio is 1.8 times. Swap ratio is 1.8 times. No, 60 divided by 90 is the wrong answer. It is not 0.667. It is 1.8 times. So the exchange ratio is 1.8 times. For every one share of the target company, we have to issue them 1.8 shares in the bidder company because we are giving some extra value to them. We are giving value worth 90,000 to them. Okay. So the share exchange ratio will be 1.8 times. The exchange ratio will be 1.8 times. 36,000 is the value of the target company. Number of shares of the target company which is to be newly issued, and 20,000 is the number of existing shares. Got it? So 1.8 times. Now next is what will be the exchange ratio. Alternatively, the exchange ratio can be computed in a very simple manner also, guys. And what is that simple manner? Simple manner is 90 rupees is the benefit which is to be given to shareholders of the target company. Okay, and the market price of the acquiring company is 50 rupees. So how many times number of shares are to be issued? 90 divided by 50. That's an easier way to calculate the exchange ratio, which is 1.8 times. So that's an easier way. That's an alternative, and it's an easier way to compute the same ratio, 1.8 times. Please comment a yes if you understood this entire concept. Now, computation of new shares to be issued by acquiring company, we have already computed it, guys. In our last point, we have already computed what are the number of shares to be issued. 36,000 shares are to be issued. So 20,000 shares are the old shares. 1.8 times. 36,000 shares are to be issued to the shareholders of the target company. 36,000 shares. So the new number of shares to be issued to the issued by the acquiring company is 36,000 shares. Now what will be the new earning per share post merger? Post merger earning per share is required to be calculated, guys. So first of all, we are going to add up the earnings. No synergy in earnings is at least given in the question. Okay, so we'll add up the earnings first. Both the earnings are required to be added up. So 2,50,000 plus 72,500 plus 72,500 divide by number of shares which are there of the acquiring company, which is 1,10,000 shares, plus number of shares of the target company. So target company number of shares is 36,000 is the target company number of shares. So this will give us the new earnings per share. 1,10,000, 2,50,000 plus 72,500 divided by 1,46,000. 1,46,000 gives me a figure of 2.21. 2.21 is the new earnings per share. 2.21 is the new earnings per share. Please write a yes if you understood the calculation. 30 rupees hai synergy. Yes, per share 30 rupees is the synergy. No. But synergy is in value of share. Synergy is not in the terms of earnings. In terms of earnings, there is no synergy. In terms of earnings, there is no synergy. There is no synergy benefit in terms of earnings. There must be some other synergy benefit which is increasing the price. And that is purchase, rupees 30 is purchase price premium, not synergy. That's the difference which I made you understand in the starting of the class, that rupees 30 in this case is the purchase price premium. It is not the synergy. Of course, it's part of synergy, but synergy is not given in the question. We are taking synergy as 0. There might not be synergy in terms of earnings, but there might be synergy in some other cases. That's why synergy over here is not there. Okay. So yes, this comes out to new earning per share is 2.21 per share. 2.21 per share. Now we have to compute the pre-merger earning per share of the acquiring company. That is very simple, guys. Pre-merger earning per share of the acquiring company. Pre-merger earnings is 2,50,000 divided by 1,10,000 is the number of shares. Okay, so 2,50,000 divided by 1,10,000. 2,50,000 divided by 1,10,000. So what is the pre-merger earnings per share? It is 2.27. 2.27 is the post-merger earnings per share. New earning per share is 2.27. Pre-merger earning per share is 2.27 is the pre-merger earning per share. Now we need to compute the PE ratio. What will be the PE ratio? PE ratio will be MPS over EPS. Okay, and we have to compute the pre-merger PE ratio. Okay. Pre-merger P ratio is required to be calculated. Pre-merger P ratio is required to be calculated. So the market price per share divided by the earnings per share. That will be the pre-merger P ratio. So what is the market price per share? So what is the market price per share? ₹50 is the market price per share. 50 rupees is the market price per share. What is the earnings per share? We have just computed 2.27 is the earnings per share. 2.27 is the earnings per share. So 50 divided by 2.27, 22.03. 22.03 times is the pre-merger PE ratio. This is the pre-merger PE ratio. 22.03 times. This is the pre-merger PE ratio. So guys, you definitely need a lot of practice. I hope you are now understanding that. Some people feel that, oh, we know BVM, SPM well, and we understand their concepts well, and we will be able to attempt it in the examination. But when the examination actually comes, you fail. because there's a slight movement in the type of questions which you have done in class and which comes in the examination. If there's slight variation in those questions, you just lose your confidence. You must be feeling exactly the same right now, because when you did your regular lectures, then you would have thought that, oh, I know all the questions well, I know them well. But when in revision you are repeating those questions, then you realize that there are some fallacies, there are some shortcomings in your answer. In your revision, there's some shortcoming, and that you only realize by practice. Okay. Last is competition. Last 2 points. Competition of post-merger share price. You have to compute post-merger share price. What is the share price post-merger? So PE ratio post-merger, which is the same as the pre-merger PE ratio, and EPS post-merger. This you compute yourself, guys. And even this part, competition of post-merger equity ownership distribution, both of these you calculate yourself. So first you calculate point number 6 yourself, and then I'll be able to tell you point number 7. Okay. Okay, yes, you have computed the answer. Perfect answer. Very good answer. Very good answer by Suman. Suman, very good answer. Perfect answer. Okay, let's see. What is the P ratio? It will remain the same, 22.03. What will be the post-merger EPS? Post-merger EPS is 2.27. So, this will give a figure of 48.69. Perfect. 48.69. And guys, after every answer, you must mention the concluding line. That is mandatorily to be mentioned. Concluding line is mandatory. So the concluding line is post-merger MPS is computed as rupees 48.69. 48.69. Perfect. And the last part is computation of post-merger equity ownership distribution for target company. So what will be the equity ownership for the target company, and what will be the for the target company shareholders, and what will be the equity ownership for acquiring company. So both target company and bidder company post-merger, what will be their holding in the new company? What will be their holding in the new company? That is what we need to understand over here. Okay. So first of all, what will be the equity distribution for target company? So the number of shares which target company shareholders will have is 36,000. This is the new number of shares which target company shareholders will have. It will be 36,000. And what are the total number of shares of this company post-merger? It will be 1,10,000 plus 36,000. It is 1,10,000 plus 36,000. So 36,000 divided by 1,46,000. The equity ownership will be 24.66%. 24.66% is the equity ownership post-merger of target company. Very good, Suman. Very good answer by Suman. Very good. Perfect. And for acquiring company, what will be the shareholding for acquiring company? It will be 1,10,000 shares of acquiring company post-merger. Divide by again 1,10,000 plus 36,000. 1,10,000 plus 36,000. So 1,10,000 divided by 1,46,000. The equity ownership percentage will be 75.34%. 75.34%. This will be the equity ownership distribution. So we'll conclude 24.66% and 75.34%. 24.66% and 75.34% is the equity ownership. So 8 marks question, and trust me, such an easy question, but students get confused in this question a lot. A very, very easy question. And remember one very important thing, over here we are just filling in the blanks, but practically you have to present your answer in the similar way. So while practicing this question on your own, you have to write the complete answer in the way it is given in this particular booklet. Don't just think that, so we will just fill in the blanks in examination also. No, in examination you won't get this format prepared and you just have to fill in the blanks. That is not true for the examination perspective. This is absolutely not true. Okay. So in examination you have to do the complete answer. So please write the captions in detail. Please write the formulas in detail. Please write everything in great detail. From an exam standpoint. Please practice the questions well, because practicing will be the key. All right. The next part is you need to compute the acquirer's gain. Okay, next topic is acquirer's gain, and we have already discussed this in brief, guys. What is acquirer's gain? Acquirer's gain is nothing but synergy minus premium. Whatever synergy has been earned by the bidder company minus the premium that we have to share with the target company, that is the acquirer's gain. So if I were to ask you that, what does the bidder company earn out of this merger deal? Obviously, it will get the target company, that's for sure. But what is the additional benefit that bidder company will earn from this merger deal? It will be the synergy benefit, minus whatever portion of synergy benefit is to be shared with the target company, that will be reduced. So it will give you the acquirer's gain. That is the concept of acquirer's gain. The reason that any acquirer would be willing to pay a takeover price more than the target's market value is because it believes that the benefits it would derive from the merger exceeds the premium paid for the target. So obviously the expectation is that synergy is higher than the premium. Synergy that will accrue is much wider than the premium. So with that expectation, every acquirer will pay extra to this for this acquisition. All other factors remaining the same. Synergies increase the acquirer's gain from the merger, while the takeover premium paid to target shareholder offsets any gains to the acquirer. So the concept is that we are going to have synergy gain. Synergy increases, and whatever is the amount that is paid to the target, that is reduced. That is the purchase price premium. It gives us the acquirer's gain. So synergy created by the transaction, P price paid for the target company of the deal. This is just a formula, but the basics you are already aware about the basics. Okay, this is just the formula which is there. Okay, in case deal takes place via exchange of shares, the PT shall be the proportionate value of the combined firm. I'll explain this concept to you. Okay, by way of example, I'll explain this concept to you. This entire concept. Okay, sir. Okay, let us directly jump on to the question, and in the question only I'll explain the entire concept to you. Okay, now illustration number 6. Sandy company is contemplating acquisition of Windy company. So Sandy is the bidder company and Windy is the target company. Sandy is the bidder company, Windy is the target company. The values of the two companies are 20 lakhs and 10 lakhs respectively. So bidder company is for 20 lakhs and the target company is for 10 lakhs. Sandy company estimates that by combining two firms, it will reduce the marketing and other administrative cost by 50,000 per year in perpetuity. Perpetuity means forever. Forever, 50,000 benefit will accrue to both these firms. The acquiring company, which is Sandy company, will actually benefit out of this. So synergy benefit is 50,000 rupees forever. Forever 50,000 rupees will be saved. Okay, great. Sandy company can either pay 14 lakhs in cash. So Sandy company can immediately give the shareholders of Windy company entire amount of 14 lakh rupees. Okay, they can immediately pay it in cash, okay, and get done with the transaction immediately right now. Or the offer can be 50% holding in the Sandy company. So, the other offer can be, 50% of the Sandy company can be owned by Windy company shareholders. So shares, if share exchange happens, then 50% of, the Sandy company shares can be taken up by Windy company. So 50% can be the ownership. The opportunity cost of capital is 10%. So cost of capital or the discounting factor is 10%. That is also given to you. Now required. What is the gain from the merger? What is the benefit that will accrue from the merger? Okay. Again, the gain is required to be computed. Second, what is the cost of cash offer? If cash is being offered, then what is the cost of cash offer? What is the expense that is being borne by the bidder company? And next is, what is the cost of stock alternative? If you purchase the company in stock, by giving your shares, you are purchasing the company, then what will be your cost? Okay. So, the value which is the gain from the merger shall be very simple, guys, straightforward. The gain of the merger is a reduction of cost due to the merger. That is the gain which is accruing, which is the synergy benefit. Synergy benefit is the gain of the merger. Okay, whatever benefit is accruing to the company by this reduction in cost. So reduction in cost is 50,000 forever. Remember the discounted cash flow technique for discounting a cash flow which is accruing to us forever. Then what is the formula? Formula is the amount that is being accrued to us, that is 50,000 rupees, divided by the cost of capital. So the benefit is 5 lakh rupees is the value of the benefit. I'll explain this, okay? Now, if there's a free cash flow which is accruing to you and forever, then the value of that particular benefit is FCFF, that is a free cash flow, divided by the cost of capital. If the discounted cash flow is to be computed for a limited time period, right, for 5 years at the rate of 10%, then we do a present value factor working. Present value factor working is to be done. But when it is for perpetuity means for infinite period, 50,000 rupees will be earned by us for infinite period. Then we cannot use that tabular formula for this is the earning, this is the PVF, we multiply by PVF, then we compute the present value. We cannot do that because it's forever. So in that case, the formula converts into this formula, FCF divided by K. Otherwise, in limited benefit, the formula would have been FCF into 1 plus growth rate divided by FCF divided by FCF divided by 1 plus K raised to the power 1 plus, this is for first year. For second year, FCF2 divided by 1 plus K raised to the power 2. We do it for a limited period discounting. But if the discounting is for perpetuity, if the discounting is for infinite years, because it is written that the benefit is going to be accrued for perpetuity. Perpetuity means infinite years, or so to say forever. Okay, if the benefit is accruing forever, then guys the formula changes to this formula, free cash flow divided by K. So that's exactly the formula which we are using. 50,000 rupees is benefit which is accruing to us till perpetuity. 10% is the cost of capital. So the present value of this gain is 5 lakh rupees. 5 lakh rupees is the present value of the gain. So gain from this merger which will be accruing is 5 lakh rupees. 5 lakh rupees is the benefit which will be accruing because of this merger. Okay, sir, got it. Now, what is the cost of cash offer? The cash offer is that the Sandy Limited will need to pay 14 lakh rupees in cash. And what will Sandy Limited acquire in return? 14 lakh rupees is to be paid in cash by Sandy Limited to Windy Limited. What will Sandy Limited acquire in return? Sandy Limited will acquire a company worth rupees 10 lakhs. Okay, this is the benefit which will accrue to Sandy Limited. So 14 lakhs minus 10 lakhs. 14 lakhs minus 10 lakhs. This is the cost of cash offer. So this comes out to 4 lakh rupees. Now usually students are stuck over here by one question. Students are generally asking me one question over here. Okay, sir, we have to pay 14 lakh rupees, right? We are getting a company worth 10 lakh rupees, right? But sir, we are also getting value of the company increased by 5 lakh rupees, which is the synergy. We are also getting the synergy. So sir, ideally, we should also subtract synergy from here. This is the question which I usually get from students, that sir, we should also subtract synergy from here. No guys, we don't subtract synergy from here. Why? Because in case of cash offer, the shareholders of the target company are done away with right now, right there. They are done away with. The transaction ends there and then. So we are calculating the cost which accrues to for this merger there and then. And 5 lakh will accrue over a period of time. It will not accrue immediately. It will accrue over a period of time. So in case of cash offer, while computing the cost of cash offer, we do not consider the synergy benefit which is accrued to us, because it will be accrued over a period of time. In case of cash offer, we always compute the cash offer in terms of current status. Current status is that we are going to pay 14 lakh rupees and we are going to get a company worth rupees 10 lakh rupees. We do a cost offer of today because nothing is going to remain in future. In case of stock, the shareholders of the target company are going to remain with the company over a period of time, for a very long time. Okay, so in case of cost offer, do not subtract synergy from here. It shall only be the cash which is paid minus the value of the company which is being acquired, which is the target company, 10 lakh rupees in this case. So the cost of cash offer is 4 lakh rupees. Cost of cash offer is 4 lakh rupees. Now the second ask is, what is the cost of a stock offer if the exchange takes place in terms of stock? If Sandy Limited, Sandy company pays in terms of stock rather than cash, then what will be the cost offer? Now the question is, again, what is the sacrifice which Sandy company will make in this case? In this case, it was 14 lakh rupees. In case of stock, what will be the sacrifice which Sandy company will make? It will not be in monetary terms because Sandy company is not paying cash. It will not be in monetary terms. What will it be? It will be the share of Sandy Limited, which Sandy Limited shareholders will forego for the shareholders of the Windy Limited. So assume that this is the entire company Sandy Limited, okay, and this is the acquired company Windy Limited, and some portion of this entire firm will be sacrificed for the shareholders of Windy Limited. This is the sacrifice which will be done by Sandy Company Limited shareholders. This will be the sacrifice. So the combined firm, the value of the combined firm in proportion to the value which is to be disbursed to the shareholders of Windy Limited, that will be the sacrifice which Sandy Limited will do. So while we are calculating cost of stock alternative, the formula is the number of shares multiplied by the present value of Sandy plus Windy Limited, which is the combined entity, minus the present value of Windy Limited. We'll understand this formula in great detail. Combined value of the firm will be value of first of all Sandy Limited, okay, value of Sandy Limited 20 lakhs, value of Windy Limited 10 lakhs. We'll add up both of them, 20 lakhs, 10 lakhs, plus the additional benefit which we are going to get in terms of synergy, which is 5 lakhs. Over here 5 lakhs is to be considered. Why sir, why over here 5 lakhs is to be considered? Because guys, in this particular case, the shareholders of Windy Limited will become shareholders of Sandy Limited, and over a longer period of time we'll be computing the cost of stock alternative. So in this case, synergy benefit will be added to this computation. So the total value is 35 lakhs of the combined entity. Okay, so this is the total value of this entire chunk. This entire chunk, the total value is computed as 35 lakhs. Now I need to calculate the value of this chunk which is shared with Windy Limited, which is given to Windy Limited shareholders. I need to find this value. Okay, so what I'll do is, hence the value of stock offered is, now 50% of the entire company will be given to the shareholders of Windy Limited. This is given in the question. 50% will be given to shareholders of Windy Limited. Okay, so out of 35 lakhs, 50% will be given to shareholders of Windy Limited. So 17.5 lakhs will be given to shareholders of Windy Limited. So 17.5 lakhs will be the sacrifice which Sandy Limited will be doing for purchasing this particular share. 50% will be the sacrifice. 17.5 lakh rupees will be the sacrifice which will be done. Now, yes, now we need to compute the cost of this alternative. Cost of alternative will be what is the sacrifice which is being done. The value of the sacrifice is 17.5 lakhs is the sacrifice which is being done. What is being acquired in place of this sacrifice? 10 lakh rupees is acquired in place of this sacrifice. The value of Windy Limited is 10 lakh rupees. 10 lakh rupees is acquired out of this sacrifice. Okay, sir, got it. So now the question is, what will be the value of stock offer? Value of stock offer is 7.5 lakhs. 7.5 lakhs is the value of the stock offer. Value of stock offer is 7.5 lakhs. So value of cash offer is 4 lakhs. Value of stock offer is 7.5 lakhs. And of course, you have to write the conclusion as well. Conclusion is to be written in detail, guys. If you understood the question, please write a yes in the chat box. If you understood, please write a yes in the chat box. So very, very important question from an exam standpoint. Again, little bit twisted, guys. Little bit twisted than your regular, answers. But this question comes in the examination, and it's a pretty straightforward kind of a question. It's just that it's little bit twisted. Okay, but if you understand the twist, if you understand how to calculate the cost of cash offer, if you understand how to calculate the cost of stock offer, it is really a cakewalk for you. It's not difficult at all. It's a cakewalk for you. Okay, so this is illustration number 6. Now we come on to illustration number 7. Again, an important question. The following information is provided relating to acquiring company E Limited. So E Limited is the bidder company, and H Limited is the target company. So detailed information has been given to you of E Limited and H Limited. Number of shares are given to you. Market capitalization is given to you. PE ratio is given to you. If you divide number of shares by market capitalization, you are going to get the MPS also. And to calculate the EPS, we can use the PE ratio to compute the EPS. So all the information is given within these 3 lines to you. Okay. Then reserves and surplus is given to you. Promoters holding is given to you. So out of the number of shares, 20 lakhs, 9.5 lakhs belong to the promoters. Promoters means the owners of the company who floated the company. Okay. And then we have H Limited, which is the target company. In case of target company, the promoters holding is 10 lakhs and the total holding is 15 lakhs. So 10 lakh rupees is held by the owners who have floated the company. 10 lakh divided by 15 lakhs. The board of directors of both the companies have decided to give a fair deal to the shareholders. Now, H Limited is the target company, E Limited is the bidder company. They are going to decide the swap ratio now. What will be the swap ratio? Accordingly, weights are decided as 40, 25 and 35 respectively for earnings, book value and market price per share. So EPS is to be considered as 40%. Book value per share, BVPS, is to be considered as 25%, and the market price per share is to be considered as 35%. So in this case, the swap ratio is not computed only by using one measure. It is a culmination of many measures. It's a weighted average of many measures according to which the swap ratio or exchange ratio is computed. So in this question, there's a speciality that not only one measure of swap ratio is undertaken, but multiple measures of swap ratio is undertaken. Calculate the following. First of all, you have to calculate the market price per share, earning per share and book value per share of both the companies. Then you have to compute the swap ratio. Then you have to compute the promoters holding after acquisition. So after acquisition, what will be the holding of the promoters in the entire company? Currently, the holding of the promoters is 9.5 lakh divided by 20 lakhs, okay, and 10 lakh divided by 15 lakh. That's the percentage of holding which promoters have before merger. But after merger, what will be the the holding percentage of the promoters? That is the ask. Then EPS of E Limited after acquisition of H Limited. What will be the new EPS? You have to compute the new earnings per share also. Then expected market price per share, market capitalization of E Limited, bidder company, expected MPS and market capitalization after acquisition, assuming P ratio of E Limited remains unchanged. So P ratio remains unchanged. You have to compute the expected market price per share and capitalization. Free float market capitalization. Free float means other than promoters. Free float means other than promoters. So market capitalization which is held by general public like you and me, other than promoters, what will be the free float market capitalization? That also you need to compute. So again, a 8 marks question, but a very simple question, guys. Very, very simple question. All right. Now let's compute. First of all, the earning per share is required to be computed, market price per share is required to be computed, and BVPS is required to be computed. These 3 things are required to be computed in our first part. Okay. So first part, these are the particulars. We are just going to fill the table, but obviously guys, in your examination you need to compute the entire table and you need to fill it yourself. So table is to be written by you in the examination. It will not be given like this. I hope you are aware. The table will not be given. You have to prepare the table. Yes sir, we know that we have to prepare the table. All right, let us now first of all fill up all the blanks. Let us see what are the... Okay, market capitalization is given to us, guys. I already told you, the figures of MPS can be computed easily. EPS can be computed easily because the figures are given to us. So market capitalization in this case is 1000 lakhs. H Limited 1500 lakhs. This is 20 lakhs. Okay, number of shares is 20 lakhs. Number of shares is 15 lakhs in this case. So obviously the market price per share can be computed by dividing both of the above things. So you can put it as A, this is as B. C is equal to A divided by B. So market price can be computed like this, okay. So this is 50, this is 100. This is the market price. P ratio is already given in the question. Guys, P ratio is already given in the question. Yes, P ratio is 10 and 5. P ratio is 10 and 5. This is D. So E is equal to... So P ratio is equal to MPS over EPS. So E will be MPS over P ratio. This will be E. E will be MPS over P ratio. 50 divided by 10, 5. 20 is the P ratio of H Limited. EPS, okay. EPS is rupees 5 and rupees 20. Okay. Now what will be the profit? Profit will be EPS multiplied by number of shares. So F is equal to E multiplied by B. E multiplied by B. That will be the profit. Rupees 100 lakhs and 300 lakhs. What will be the share capital? Share capital is already given in the question. 200 lakhs and 150 lakhs. So share capital will be, okay, over here share capital is given, number of shares is given, and face value of each share is given. So we just multiply the face value by the number of shares, we'll get the share capital. Reserve and surplus is also given to you as 600, 330. 600, 330. Rupees 600 lakhs. And rupees 330 lakhs. Rupees 600 lakhs and rupees 330 lakhs is the reserves and surplus. That is the reserve and surplus. Now what is the total book value? So F, this is G, this is H, this is I. So this is rupees. Rupees 800 lakhs and 480 lakhs. Now we're just going to divide the total book value I, J is equal to I, divide by number of shares. Divide by number of shares. Number of shares is B. I divide by B. So 100 divided by 20. This comes out to 40. 480 divided by 15. This comes out to 32. So what is the BVPS? BVPS is 32 and 40 respectively. Please let me know. Guys, don't copy the answer. Please don't copy the answer. That is one instruction that I would like to give all of you. Please don't copy the answer. Compute all the answers so that you get practice for examination also, because in examination sometimes, very small calculations like what will be the BVPS is confused by you because you have not practiced enough. So do not copy the answer at all. That's a warning which I give to all the students. Practice the answers yourself. Now calculation of the swap ratio. Swap ratio is to be computed, guys, and swap ratio will be a weighted average of all of these ratios. It will be weighted average of all of these ratios. Okay. So first of all, what will be the EPS? EPS is 20 and 5. Bidder company is E Limited, S Limited is the target company. So EPS is 5 and 20. So the EPS of the target company divided by EPS of the bidder company. So 20 divided by 50. What is the ratio? What is the percentage that we are going to give to this particular factor? It is 40%. We are going to give 40% to this particular factor. So 20 divided by 5 multiply by 40%. So the ratio which will go, weighted average ratio which will go is 1.6. Next is BVPS. BVPS is 32 divided by 40. That is the BVPS swap ratio. 32 divided by 40. And what will be the percentage, weighted average percentage? It will be 25%. 25%. 25%. So the weighted average swap ratio will be 0.2. Next, what is the market price? Market price per share is 50 and 100. So it is 2 multiplied by 35%. 35% is the weighted average ratio. Okay. So 2 multiply by 35% gives me a figure of 0.7. So what is the total value? Total value is 2.5 times. So what is the swap ratio? Swap ratio is 2.5 times. Please tell me if you have computed the swap ratio. Please comment in the comment section below if you have computed the swap ratio. Suman, what is the swap ratio? Please tell me. Swap ratio is 2.5 times. So swap ratio for every one share which is to be issued is 2.5 shares of E Limited. Total number of shares to be issued is how many shares are existingly there in case of the bidder company, the target company. Target company number of shares is 15 lakh. 15 lakh multiplied by 2.5. So it is 15 lakh multiplied by 2.5 times. 2.5 times of 15 lakh. Very good. 2.5 is to 1. Perfect. So the number of shares is 37.5 lakhs. Total number of shares to be issued is 37.5 lakhs for the the target company. So this is the answer of part 2. What is the swap ratio? Swap ratio is 2.5 times and the number of shares to be issued is 37.5 lakhs. Okay. Now what is the promoters holding post merger? After merger, what is the promoters holding? That is the ask. Okay, so promoters of the company, what is their holding, which is promoters of the the bidder company. Promoters of the bidder company. Promoters of the bidder company have total 9.5 lakh shares. Okay, promoters of the bidder company, because post merger target company will not be there. So we are talking about the promoters of the bidder company. So currently they have 9.5 lakh shares, right? Plus, how many new number of shares will be there for the promoters of the target company will also be having some fair bit of shares in the bidder company, right? So the number of shares which are there for promoters of the bidder company is 10 lakhs. What will they get in the bidder company? So 10 lakhs is the promoters of the target company, multiply by 2.5 is what they are going to get in the bidder company, right? So what will be the total of both of these promoters holding in the total company? 9.5 multiplied by 9.5 plus 25. Total of both the companies. Total of both the company's promoters will be 34.5 lakhs. And what will be the total number of shares of the total of the total company? 34.5 lakhs divided by, what is the total number of shares? 37.5 lakhs is additionally to be issued over and above the existing number of shares. Existing number of shares is 20 lakhs. Okay, so total number of shares is 57.5 lakhs. Gives me a figure of 60%. So post merger, the number of the percentage promoters holding percentage will be 60% of either the target company's promoters or the bidder company's promoters. The total percentage combined promoters after the merger will be this. Okay, this is how we are computing the number of equity. So 20 lakhs is existing and we are issuing 37.5 lakhs for the bidder company. So total is 57.5 lakh shares. 57.5 lakh shares. Okay, please comment in the comment section if you understood this calculation. This is an important calculation, guys. Now what will be the EPS after merger? After merger EPS, the new earnings divided by the new number of shares, that will be the EPS calculation after merger. What will be the EPS calculation after merger? So the total number of shares after merger is 20 lakh plus 37.5 lakhs, which is 57.5 lakhs. Total profit is, both the profits are to be added. Both the profits are already given in the question. Profit, we have computed both the profits, guys. Profit will be 100 lakh and 300 lakh. 100 lakh and 300 lakh divided by 57.5 lakhs. So 400 divided by 57.5 lakhs gives me a 6.96. 6.96 per share. 6.96 per share is the earnings per share. And you have to conclude also, guys. Hence the new EPS of merged entity. Okay, always write this line, is 6.96. Okay, calculation of market price and market capitalization after merger. So what will be the market price after merger and market capitalization after merger? Obviously, we have to assume that P ratio remains the same after merger. So EPS of the company after acquisition, market price after acquisition, assuming P ratio remains the same. Okay. If P ratio remains the same, then it's easier for us to calculate the market price. So expected market price will be EPS. EPS is already given to us, is computed by a 6.96. What will be the P ratio? P ratio will be the same. What is the pre-merger P ratio? It is 10. So it will remain same for post-merger also. So the market price is 69.6. 69. Okay, let's be precise. 69.56. So what is the market capitalization? Number of shares multiplied by the market price per share. So 69.56 multiplied by 57.5 lakh shares, which are post merger. Post merger number of shares is 57.5 lakhs. Okay, so this gives me a total figure of which is round about equal to 4,000 lakhs. So what is the value of the firm post merger? 4,000 lakhs is the value of the firm post merger. 4,000 lakhs is the value of the firm post merger. Now the next is free float market capitalization is required to be computed. So guys, out of 4,000 lakhs, 40% is the free float. How do you compute 40%? 40% is 1 minus 60%. 60% we have already computed as the promoter's holding. So remaining is the free float holding. 60% is the promoter's holding. We have already calculated in our earlier parts, right? So 40% is the free float holding. So again, it is like 4,000 multiplied by 40%. And yes, we should, for a presentation standpoint, we should write it completely using the entire calculation. 69.56, 57.5 lakhs multiplied by 40%. 1,600 lakhs is the answer. Approximately 1,600 lakhs, okay. Okay, then again, you need to conclude, hence the free float market capitalization of the company is computed as rupees 1,600 lakhs. That is essential. That is non-negotiable. Guys, that is non-negotiable. That is essential. Okay, sir, got it. If you understood the answer, please comment yes in the chat box if you understood the answer. Any questions? Please tell me if you have any questions. And yes, self-practice is non-negotiable. I mean, just doing the questions in class would not suffice. Self-practice is really important. Now I'm going to do a very simple question which came in June 24, and students were actually afraid. Students were actually very jittery. Oh, what kind of a question is it? After completing the question, you yourself will say, oh, it was so easy. So, only the wordings of the question have been changed in a manner so as to confuse you or so as to create panic in your mind. It is that panic in your mind which is created by the examiner. But the question is very simple. Answer is also very simple. But most of the students were unable to attempt this question when it came in the examination. So guys, let's do this question. Illustration number 8. Hypothetical Limited is acquiring all outstanding shares of Target Limited. So Hypothetical Limited is the bidder company. And Target Limited is the target company by exchanging one share of its own equity shares for each share of Target Limited. Hypothetical Limited has a policy of keeping 50% of its capital structure in debts. So 50% of capital structure is to be kept in debt by Hypothetical Limited. That is a policy which Hypothetical Limited creates. The swap ratio is given to you guys. Swap ratio is 1:1. Outstanding equity share target by exchanging one share of its own equity share. So swap ratio is given to you 1:1. Then debt to capital ratio is given to you. 50% should be the capital structure which hypothetical company usually keeps. Okay. The capital structure of both these firms before the merger is given to you. So the capital structure is given to you in this way, guys. First of all, equity is given to you. This is equity plus retained earning. This is given to you. Then preference debt is given to you. Then debt is given to you. Hypothetical company needs your advice on the following questions. What will be the capital structure of the merged firm? So if these two firms merge together using this swap ratio, what will be the revised capital structure? Because it is going to be changed, right? Debt is to be kept as 50%, but now it will change because equity will be more in this case. Currently debt is 50%. If you see, currently debt is 50%. Look at this difference, okay? This is 50, this is 50. Currently debt is 50%, but after merger, it is going to change. So what will be the changed structure that you need to comment on? Determine the percentage share of debt in the merged firm. You have to compute the percentage share of debt. In a usual question of merger and acquisition, new earning per share is required to be computed usually. Swap ratio is required to be computed. There they have asked to compute something different. That's it. But nothing very extraordinary, nothing very, very difficult. Okay. Second is, has the merged firm financial risk declined? Will the financial risk decline? If obviously the debt percentage goes down, then financial risk will also decline. Okay. But that is the next question. The third is, how much additional debt can be combined firm borrow to return to a capital structure of 50%? So what will be the additional debt that the merged firm will borrow to come back to the original level of 50% of debt capital structure? These are the three questions, and answer is really simple and straightforward, guys. Okay. But guys, yes, students get confused in this particular kind of question. All right, so what will be the capital structure of merged firm? What will be the capital structure of merged firm? First of all, equity. Okay, they have 20 lakhs as equity. 1:1 share is going to be merged of 5 lakhs. So the revised equity capital will be 25 lakhs. Revised equity capital will be 25 lakhs. So 20 lakh plus 5 lakh, this gives a figure of 25 lakhs. 25 lakhs will be the revised equity capital of this particular entity. What will be the retained earning? Retained earning is 25,000 plus 25 lakhs plus 25 lakhs. Okay. So the revised retained earning will be 50 lakhs of the merged entity. We are calculating of the merged entity. Okay. Then what will be the preference shares? It will be 5. And what will be the debt? Debt will be 50. So what is the total all of these? Total will be 130. 130 will be the total of all of these. This is of the merged entity. This is of the merged entity. Okay, sir. So what is the revised debt percentage? Revised debt percentage is 50 divided by 130. 38.46%. 38.46%. This will be the debt of the merged firm. Okay, now the question is that earlier the percentage was 50%. Now the percentage has declined to 38.46% of the debt in the entire capital structure. Will the financial risk go down? Answer is yes, financial risk will go down. If debt is used less in the capital structure, then financial risk will definitely go down. Okay, so yes, the financial risk has declined due to lower debt ratio of the merged firm. The same was 50% pre-merger. Now it is 38.46% post-merger. So yes, obviously the financial risk is going to decline. It is going to go down. Now the next task is how much additional debt should we add on? So 1350 in 50, how much should we add on that our revised percentage is coming out to 50%? We have to compute the additional debt which we can merge, which we can add on. So that the revised ratio should be 50%. Very simple, guys. I'll assume that the additional debt is X. If additional debt which is added is X, then 130 will also increase by X. Okay, then the equation will be 50 plus X divided by 130 of X should be equal to 50%. This is the quadratic equation that I'm going to form and compute my answer. Very simple, very simple. Let the additional debt which is to be introduced is X. Oh, Suman has already computed the answer. Very good, Suman. Let the additional debt which is to be introduced is X. Okay. No, we don't want in percentage terms. We don't want in percentage terms. We want in rupee terms. Rupee. So you have to compute in rupee terms. Okay. So computation of additional debt to return to capital structure of 50%. Let the additional debt borrowed be X. So earlier it was 50,000 divided plus X divided by 1,30,000 plus X is equal to 50%. Okay. So this gives me a figure of 50,000 plus X is equal to 50% off. So we multiply it on the other side. Okay. We just solve this equation. So 1,30,000 plus X will be multiplied with 50%. So X will be 50% off X. 50,000 will go there. So this will come out to 65,000. $15,000 X will go there in minus. Minus X. Very good answer. Perfect answer. This will come out to 15. So this will come out to 30 lakhs. Okay. 30 lakhs. 50 lakhs. This is 15 lakhs. 15 lakhs. So X is 30 lakhs. So additional debt which is to be borrowed is 30 lakhs. I just solved the entire equation, guys. I just solved the entire equation. You just have to solve the entire equation. So X will be 30 lakh. The additional debt to be borrowed is 30 lakhs to come back to your original percentage of 50%. By adding 30 lakh rupees of debt, you will come back to your original capital structure of 50%. Hence the additional capital to be borrowed is 30 lakhs. So very simple question, requiring the students to really answer very simple part, but the students got confused because they thought that there'll be something technical to this question, there'll be something very difficult to this question. Nothing of that sort, guys. Very simple and straightforward question which comes in the examination like this. And yes, after this I have given you plethora of practice questions. My hunch feeling is that if you solve all these practice questions by yourself 3 times, not one time, 3 times. If you solve all these questions 3 times by yourself, there will be no question that you won't be able to understand in the examination or attempt in the examination. The idea is not to attempt the Googlies to the extent of 100%. The idea is to attempt the Googlies to the extent of 50%. Just score 50% in the Googly questions, that's it. That is my ask from all of you. Yes, so these are the practice questions which you need to do, guys. And these are the MCQs which you need to perform. There are MCQs which I have given on the back side. These MCQs you should do yourself, and yes, then you are prepared with this chapter, mergers and acquisition, and I'm very sure that you will get bare minimum 15 out of 20 marks in merger and acquisition, because 20 marks question is expected from merger and acquisition. 15 out of 20 is a bare minimum expectation after you complete this entire portion. Yes, merger and acquisition is yours.